We've seen perpetual market strength.
The eyes continue to be on earnings.
It's an earnings momentum-driven market.
It will continue to be an equity story as we go forward.
Things are about as good as they've been in a really long time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, holding on. President Trump claiming the Iranian ceasefire is on life support as investors are gearing up for a headline inflation number closer to 4%. Republicans are beginning a push to suspend the federal gas tax, an effort to counter rising prices at the pump.
Consumer prices are starting to become a problem for both politicians and, frankly, on the margins for bond markets. That will be highlighted by today's CPI report heading into tomorrow's PPI report. And, of course, we do have a bond auction, $42 billion of 10-year notes at the same time. From the political point of view, you have a question of how you can ameliorate some of the costs, whether it's the gas tax holiday, whether it's taking down the SPR. In the bond market space, a real question about how sticky this inflation will be because of proposals coming from the other side, the fiscal side.
Welcome to Washington, Kevin Walsh. Step right up. We talked about this a few times already this week. Unemployment closer to 4, headline inflation getting closer to 4. You've got core CPI closer to 3 than 2, and a Fed maintaining an easing bias. That's a tough meeting in June to walk into.
It's one where he potentially has a pass to stay on hold, but how do you reconcile some of the calls from President Trump to lower interest rates with the idea that inflation expectations are creeping higher? And there's a warning shot coming from the United Kingdom, given the fact that we're seeing right now spreads, or at least yields on 30-year gilts, going to almost 6%. We're talking about 5.8% for the first time going back to 1998. This is a warning shot for the United States. If you have a situation where the fiscal outlook looks somewhat like it's not mathing, then the bond market will respond. And that is going to be a concern for any Fed chair that steps into this particular
Right
situation.
now might feel like a stretch to compare this situation to the UK. Do you want to talk about the UK right now?
The UK is fascinating.
The GDP close to 1%, nowhere near the kind of growth we've got in America. A Bank of England that may have to hike interest rates soon. And as you indicate, a 30-year yield at the highest level we've seen going back to 1998. We have seen Prime Minister after Prime Minister, and this Prime Minister is struggling to hold on.
This isn't a Liz Truss moment. This is a political and financial reality right now for the United Kingdom. I do think it's fair to keep asking how much is this a warning shot for other developed market economies that are facing off with fiscal deficits that are pretty big, and a question of how long they could sustain growth, given the fact that on the margins they're kind of tapping the fiscal pumps a little bit too much. At the same time, it is a situation unto itself. And ultimately, whether Keir Starmer stays or whether he goes, bond traders seem to be suggesting that there has been no plan that's been put out there that has been fiscally sustainable, and they are pushing back.
There's a fear about what comes next. Here's the pushback, up 10 basis points this morning. The 10-year through 5% on 10s in the UK, 30s. To Bramo's point, approaching 6. If you want some fun and games, let's talk about the Kospi in South Korea. Overnight at one point, down as much as 5%. Before trimming those losses. Comments on Facebook by a presidential policy chief suggesting the nation should pay citizens a dividend using taxes on AI profits. He walked that back a little bit and clarified those comments, but that was a bit of a shock overnight. And I wonder if that's a taste of things to come, not next year or the year after that, but further down the line.
I'm so glad you went there. At a certain point, increasingly, people are concerned if you're going to lose your job from AI, you're going to want some sort of benefit in the form of some sort of tax refund or some sort of dividend, or citizen dividend, as this particular politician called it. Is it going to come from specific taxes on AI names? Is it going to come from the broad-based taxes that they're expecting to be bigger because of a productivity boom, which is how he walked it back? Well, it remains to be seen. Nonetheless, if you start seeing unemployment creep higher, is this a lever that some countries are willing to pull?
Off the back of that story, Nasdaq futures a little bit softer as well, down this morning by more than 0.5%. Coming up this hour, we'll catch up with Russ Koesterich of Blackrock as tech lifts stocks to new heights. Katherine Thompson of the Cato Institute with the US-Iran ceasefire on life support. And Greg Daco of EY as Wall Street awaits key inflation data. We begin this hour with stocks hovering near all-time highs. Russ Koesterich of Blackrock writing markets have staged a remarkable recovery led by tech. Earnings can continue to carry the day for US equities. Russ joins us now for more. Russ, welcome to the program, buddy. It's good to see you. What kind of a rally do we have right now? The kind of rally that sucks people in, or the kind of rally that begins to spit people out?
More, Jonathan. I think it's one that's been sucking people in. You had a market that was pretty pessimistic back in March. And what you've seen is, in addition to the fact that the economy has been resilient, the labor market has been resilient, First and foremost, earnings have been remarkable. You've seen a significant rise in earnings expectations really since the beginning of hostilities back at the end of February. And that has, of course, been led by tech. And the numbers are just off the charts. So what you have right now, I think, is an earnings-driven market, not driven necessarily by multiple expansion, but by investors looking at earnings, particularly for industries like semiconductors, and thinking, you know what, I don't want to miss this. I don't want to be underweight, given the strength of the U.S. corporate sector.
How much pushback are we beginning to get from the bond market, Russ? How much of a threat is beginning to brew in fixed income? The repricing in rates, 2s this morning, close to 4, 10s through 440, 30s at 5. How much of a challenge is that?
I don't think it's an enormous challenge right now. I mean, you've had a backup in yields. Real 10-year yields are up by about 25 basis points since the start of the war. But the reality is the bond yields are still relatively contained in the United States. I know the story is different elsewhere. You're talking about the UK a few moments ago. And bond market volatility is actually fairly muted. So there are parts of the market that are definitely struggling with higher yields. Housing-related stocks are probably the best example. But for the broader market, and particularly for a lot of the large cap segment where debt levels are relatively modest, this is not yet a headwind that's going to derail the rally.
Russ, just to stick on this for one more minute, how much are you starting to see some of the net issuance for the hyperscalers, for some of the semi players, supersede or crowd out some of the government debt sales that have to come due as well?
Well, clearly we've seen a pretty significant increase in the net issuance by the hyperscalers. But again, the reality is this is still a market with a lot of cash on the sideline. This is a market where people are still looking to build yield in their portfolio. So the notion that that issuance by itself is going to derail the bond market, I think right now that's not as much of a threat. But again, I go back to what's leading the market. Despite the increase in debt levels among some of the tech companies, the reality is we're still seeing earnings growth that is over 30%. And that's something that, as long as the debt levels remain manageable, I don't think is going to prevent investors from being the space, particularly when they're driving the earnings. And here's a telling statistic. Q1, tech is responsible for 55% of all earnings growth for the quarter. That's an astounding number. And it's telling you why people are rotating back into this space after the so-called broadening out trade that dominated in the end of 25 and early 2026.
One of the key points that seems to be underpinning the rally is the idea that this economy is at greater risk of a melt-up of inflation than it is some sort of downturn. How much do you see that as a rationale for why to continue piling into some of these big tech stocks even after the massive rally? Because ultimately, yes, the earnings are there, but also they're a hedge against disintermediation of old business models. They're a hedge against inflation. And on the margins, in the near term, they're somewhat of a hedge against the consumer cycle.
I think that's exactly right. I think this is one of the things that's happened in addition to, investors looking at the earnings numbers and being understandably impressed, is that the narrative's changed. And you think about what the narrative was back in late 25, early 26. It was one of above trend GDP. And that theory supported, again, this broadening out trade. And that included European stocks, included cyclicals, included small caps, included value, all businesses and all companies or indices with a lot of companies that would benefit from a strong economy and operating leverage. Now, the good news is we still think the U.S. economy is doing well, but what's changed is maybe an environment where rather than growing at above trend, given some of the headwinds from higher oil prices, higher gasoline, higher rates, we might be looking at an economy where the growth rate is closer to trend. If that is the narrative that investors are adopting, then going back to secular growth, where you can have these types of earnings even without particularly strong economic growth, I think that's one of the dynamics that have supported this rotation back into growth and back into tech.
Russ, it begs the question how relevant some of the economic data points actually are to the rally and the performance of equities. At 8:30 Eastern time, we get a CPI print. How important is that to you?
I think it is important because what you do have is an environment where investors know inflation is going to be above trend. The Fed knows that headline inflation is going to be higher because of the impact of oil, but there is still going to be a scrutiny, first of all, of how much is that leaking into the rest of the inflation numbers, particularly core inflation, no matter how you measure it? How is that affecting core services? And again, if you have a narrative where maybe the Fed is on hold, but they're not hiking, clearly you want to see that core inflation is remaining somewhat contained.
Russ, it's good to see you, sir. As always, Russ Koesterich there of Blackrock. Thank you. How close are we to a hike? We've gone through some of the numbers, some of the estimates a few times already. BNP, a risk of a hike this year. PIMCO, you mentioned Dan Iverson yesterday, Lisa, risk of a hike this year. Morgan Stanley have come on the programme. Fed is done for the year. Goldman Sachs, to your point yesterday, pushing back their call, I believe, now to December of this year for that first cut. Things are getting very finely balanced as to what the Fed's going to do next.
Politically, it seems implausible that Kevin Warsh will actually hike rates, and that's one reason why a lot of people are not penciling in a rate hike. But you are seeing it in the Fed funds rates. You do see some pushback in terms of just how much this Fed may have to do. You put it really well yesterday. How much is a hold essentially the most hawkish thing that this Fed can do? And ultimately, do they need to signal some sort of rate hike as a possibility in order to job on the market into submission?
Redefining dovishness over at the Federal Reserve. 30s this morning, essentially at 5%, 10s at 4.43, near the highs of the year, and 2s closing in on 4% as we count you down to that data later this morning. Let's get you an update on stories elsewhere with your Bloomberg brief. Yahara standing by with more. Hey, Yahara.
Good morning, John. President Trump saying the ceasefire with Iran is on massive life support. Trump rejecting Tehran's response to the latest peace offer, which demanded lifting the U.S. naval blockade, sanctions relief, and control over the Strait of Hormuz. South Korea's Kospi index losing more than $300 billion in value in just 97 minutes today. That sharp sell-off coming after a South Korean policymaker proposed taxing AI profits to fund a citizen's dividend. And UK Prime Minister Keir Starmer telling his cabinet he's staying on as Prime Minister despite increasing pressure to step down. Dozens of members of Parliament calling for Starmer to set out a timetable for his departure. That's your Bloomberg brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the programme, a ceasefire on life support.
The ceasefire is on massive life support, where the doctor walks in and says, "Sir, your loved one has approximately a 1% chance of living."
Crude back at triple digits. Katherine Thompson of the Cato Institute joins us next, live from New York City this morning. Good morning. This is how the day ahead is shaping up. The main event at 8:30 Eastern Time. It's a read on inflation in America. CPI at 8:30, and CPI in the months to come is going to take on more and more importance as this inflation rate, particularly at the headline level, continues to creep higher.
Yeah, we're looking right now at a year-over-year comp for CPI at 3.7% versus 3.3% in the prior reading. This is moving in the wrong direction. We're closer to 4 than we are to 3 at a time where the target is 2. And some people say, well, CPI is not what the Fed looks like. But actually, the measure that they look at, core PCE, is rising faster than CPI. So any way you slice it, this is not a scenario the Fed wants to see.
Heading into this, back-to-back all-time highs on the S&P 500. Futures pulling back by just 0.3%. In the bond market, the scores look like this. These numbers getting close to the highs for the year. 443 on 10s. Let's round it up. 5% on 30s. And once again, testing 4% on the 2-year. Yields up about a basis point across the curve.
This is the market starting to pressure a rate hike scenario for the Federal Reserve, even if they aren't coming out and even removing their easing bias. At a certain point, if you have inflation expectations, and you can see this in break-even rates starting to creep higher, you have bond yields creeping higher, you have a sense that not only is this economy sturdy, but it can withstand the increased prices from gasoline, from agricultural, from other aspects. People are starting to have to realize maybe we are in a new inflationary regime. You can hear that from Wall Street analysts in terms of what they're trying to hedge.
The move in crude is not helping, up by 3%. WTI back into triple digits, 101 this morning. Brent crude at around 107, also higher by some 3 percentage points. Under surveillance this morning, a ceasefire on life support.
The ceasefire is on massive life support, where the doctor walks in and says, sir, your loved one has approximately a 1% chance of living. I have the best plan ever. Iran has been defeated militarily, totally. They have a little left. They probably built up during this period of time. We'll knock that out in about a day.
So here's the latest this morning. President Donald Trump calling Iran's response to the US proposal a, quote, piece of garbage, while saying a diplomatic solution is still possible. Bloomberg's Mike Shepard joins us now from Washington for more. Mike, you're charged with trying to translate all of that. So the proposal is garbage. The ceasefire is on life support. What do we know about the next steps this administration is willing to take?
Well, some of those next steps, John, may actually have to wait until after the president returns from his trip to China, where Iran will be on the table front and center as an issue between the president and his Chinese counterpart, Xi Jinping. But in the meantime, they are really hoping, with that strong language from President Donald Trump, that officials in Tehran will heed what the U.S. is saying about its posture toward these negotiations. They had sent Tehran a 14-point proposal for trying to get back to the bargaining table to try to negotiate an end to this now 10-week-long conflict. And that proposal would include things like ending Iran's, at least temporarily, Iran's enrichment of nuclear materials, allowing the U.S. to take possession of some of the enriched uranium that it has, all of this in exchange for sanctions relief. Critically, John, it would also call for reopening the Strait of Hormuz. And that has emerged as a larger and larger sticking point as this drags on. We're seeing that this key choke point in the global energy supply chain really emerging as such a major factor in the conflict. We're seeing, and we'll see today with the CPI numbers, the increasing effect of what the rising oil and natural gas prices are having across the global economy. So two sides are trying to exert some leverage over the Strait of Hormuz, and it's unclear who will actually prevail and what might emerge actually from these talks in China between President Donald Trump and Xi Jinping on this regard.
Well, Shep, let's stay on those talks. Just how narrow, how focused will those talks be? How much space is there to talk about the Middle East?
Well, there will have to be space because China is dependent on the Gulf for a lot of its energy needs, and it is putting pressure on Xi Jinping to try to find alternatives to make sure that domestic needs for energy are met. And Iran has also forged this relationship with China over the years and has occasionally looked to China to try to act as an interlocutor. And more broadly, other Asian economies that also do business with China have also been feeling the pinch of energy prices rising, and that is in turn going to affect their ability to do business with their neighbor, China, the world's second largest economy. The U.S. has also been looking to pressure China over its support for Iran in terms of possible military sales of military equipment to Tehran, and as well over sanctions violations. The U.S. recently imposed sanctions on a bunch of Chinese companies, John, for buying oil from Iran against the measures that had been imposed to restrict Tehran's ability to capture global hard currency from its oil riches.
Hey, Shep, it's good to see you. We'll catch up with you again in the next hour. Shep, thank you. Just on the conversations around the meeting between President Trump and Xi Jinping, look at the lineup of CEOs that will be attending that meeting with the president, or at least attending the visit alongside him. Look who's missing. Spot the guy who's not on the screen. Jensen of NVIDIA.
Yeah, this comes after Jensen Huang said that he would be honored to accompany President Trump on this trip. And it comes with chips very much at the forefront of discussions with China. Is this a signal that maybe the president is trying to distance himself from Jensen Huang? How does this sort of leave some of the chip negotiations that have been incredibly fraught between these two nations?
You know what, from my perspective, for whatever that's worth this morning, probably not much, but I think it probably does NVIDIA a favour. Some of those chips getting into the country through the back door, people questioning the relationship between him and the administration right now. I think it probably does him a favour that there's a bit of separation on this visit to China.
Perhaps it also could be hinged on the idea that China has created some chips that are starting to work for the DeepSeek model. How much is that going to be at the forefront also of these negotiations?
Let's build on some of this conversation. Katherine Thompson of the Cato Institute writing the volume of rejections and counter proposals between Iran and the US demonstrates just how far the administration is from winding down this war. Katherine joins us now for more. Katherine, welcome to the programme. The president's been very clear on his objectives. Are you clear on the strategy to achieve them?
No, absolutely not, right? Especially because, right, if you look at the president's own national security and national defense strategy, this isn't, starting a war with Iran and sort of Iran's nuclear ambitions are not core planks of the strategy. They are not core elements of America First priorities. And so, I think, unfortunately, we've deviated quite a bit from the strategy, from the plan. And I think we're now so far down the rungs of the escalation ladder that, unfortunately, there aren't too many options left to save the ceasefire, so to speak, keep it, off of life support, as the president illustrated, and prevent the resumption of fighting.
Katherine, there is an option to try to get China to exert leverage over Iran. How much do you expect this to be on the table, and what can the U.S. offer as an exchange?
It's hard to predict exactly how much it's going to be on the table, but I think, in terms of the military dynamic between, the U.S. and China on Iran and then also on Taiwan, because I think, these pieces kind of fit together. The recent Time magazine cover that included President Trump and President Xi with the headline, "Never interrupt your enemy when he's making a mistake," I think is illustrative of how this conversation could play out. I think, for China, right, like this is the time to put big issues on the table like Taiwan, because they know that the U.S. is distracted and bogged down in the Middle East. Obviously, of course, the oil dynamic and the energy dynamic affects the Chinese, and so it's in their interest to, have that be part of the conversation, certainly. But if I was them, right now, one of the things that I would be focused on is getting sort of my security agenda on the table. And it looks like, based on what the president was hinting about, in terms of the Taiwan dynamic and arms sales to Taiwan, that it's certainly something they're not shying away from putting on the table. And I think they understand that the U.S. is significantly distracted in the Middle East yet again, not prioritizing the Indo-Pacific, as our defense strategy says. And unfortunately, that dynamic for us puts us, I think, in a bit of a disadvantage at the table across from the Chinese.
That said, there's a coterie of incredible CEOs who are heading over there. I'm just wondering what you think the deliverables are going to be on some sort of economic truce or economic negotiation between China and the U.S., and how much that could still be at the forefront of these negotiations.
I mean, it seems like that's the priority for the president, and certainly, his suite of guests that are attending would seem to indicate that as well. And right, I mean, and this is the concern, and this is why I'm watching the Taiwan piece of this so closely, because for the Chinese, the piece on arms sales to Taiwan and potential further conversations about, the U.S. role in deterrence in the Taiwan Strait becomes a forefront of the conversation for the Chinese. For us, it's the economic piece of the equation and getting walking away with some sort of economic deal, and how those two pieces on the chessboard interact with each other. I think will be incredibly important and will be, one of the most pivotal dynamics to watch. And it's true, you can't separate, the military and the strategic dynamic from the economic.
Katherine, it's good to see you down in Washington, D.C. Katherine Thompson there of the Cato Institute. I've heard that a lot, that there's space here for China to think about doing something around Taiwan. I also wonder if it's an example, a warning to the Chinese of what can go wrong once you get involved in something like this.
Well, that's the reason why some people are expecting weapon sales to Taiwan to be on the table, and China to ask the U.S. to sell fewer weapons to Taiwan. That is something that in the past, previous presidents have said they're not going to discuss. How much is that going to be on the table? Not necessarily a wholesale invasion of Taiwan. That's a step too far, and currently is not priced in any way, shape, or form to markets, but just on the margins eroding some of the protections around Taiwan.
I think the chip sector would be in a very different place.
Well, exactly.
If that was on the table.
We're not talking a sort of Ukrainian-style invasion a la Russia 2022.
Let's hope we're not anytime soon. Annmarie on the ground in China. We'll catch up with AMH tomorrow morning. Looking forward to that. Coming up on the programme, Bloomberg's Lizzie Burden as Keir Starmer pushes back on calls for his resignation. Some big moves in UK markets today. Plus, we'll catch up with Yahara. She's got your morning movers. Semi-stock sliding following a rally in Monday's session. We're down across the board. Back-to-back record highs on the S&P 500, pulling back just a little bit this morning. We're down 1/3% on the S&P. On the Nasdaq, we're down by 0.7. What a rally we've seen on semis. You've heard all of the numbers before. A gain of 70%, almost 70% off the lows of the end of March. We have only had 4 down days over that period for the semi index. It is now 18%, that industry group, 18% of the S&P 500. Isn't that crazy?
Well, it gives you a sense of how far they've come and how much this really is the picks and shovels of the entire AI story. We talk about the $800 billion of expected capex this year from the hyperscalers. That's almost all being funneled to supplies like the semiconductors. Jonathan Golub, while he was bullish yesterday, he did present this bear case that was really compelling, at least for the bond investors, which is that a lot of the hyperscalers are not booking the cost of these semis, but the semiconductors are booking the profits from the purchases that they're expecting. So there's a bit of a financial mismatch there that perhaps also is helping to shield some of the reality here.
This story shielding this equity market from these moves in Brent, these moves in crude. WTI back into triple digits. This morning higher by 3%, 107 on Brent, WTI at 101. With that move, once again, you see this move in fixed income. Yields up across the curve, 2s, 10s, 30s. At what point does that screen become a challenge to the story in the equity market? We are basically at the highs of the year on 10s and 30s, not too far away. The 30-year yield essentially around 5. 2s still comfortably above the policy rate of the Federal Reserve, 3.96, up a basis point across the curve. When does that start to become a problem for risk appetite?
When we were talking to Mike Wilson, he said right now at about 4.5%, that's when you start to see a little bit of a hesitant look over at the bond market from some of the equity bulls. It depends why you're seeing yields rise. If it is just sort of a one-time price impulse from gas or oil prices, maybe not going to have the same effect as a longer-lasting inflationary shock from, say, semiconductor component costs, or just the idea that the economy is robust enough to allow cost inflation to be passed on. Those are that's the conundrum. That you could see inflation get passed along because of the strength in the economy, which really leaves the Fed in a rocky spot.
That screen is almost comfortable compared to the next one. Switch out the board and check out the UK gilt market this morning. 2s out to 30s. Yields up by 10 basis points on 10s. We are through 5%. We are approaching 6 on 30s this morning. Now, you talked about why yields are up, and it matters what the driver is here. Compare it to the currency. Sterling's weaker. When you see the currency weaker in DM, and I'm not sure if this is really classified as DM right now, it's right on the edge of something else, and that something else is not good. A weaker currency, high yields, not a great picture for UK assets.
I haven't seen so many heads of lettuce since 2022 on Twitter, X, or whatever social media you go to. There is an issue of Keir Starmer and potentially his exit. It's also the replacement, who that could potentially be. But right now, it's clear that the Liz Truss moment was not a moment. It was something that was portraying the financial conundrum facing the United Kingdom, which is just weaker revenues, weak growth, and a fiscal deficit that continues to balloon. And when you have that type of deficit and backdrop of growth, it is toxic, and the bond vigilantes are circling like vultures.
Lizzie Burden standing by outside number 10 Downing Street. We'll catch up with Lizzie in just a moment as we count you down to the opening bell, 3 hours away. Some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. As you said, along with the broader market, the semiconductor stocks index also hitting a record high yesterday, with that index now the most stretched above its 200-day moving average since the dot-com era. But today, that torrid rally is taking a breather. We are seeing names like Intel, Qualcomm, AMD, and NVIDIA all pulling back. But of course, it pales in comparison with that rally. Turning to Hims and Hers, that stock is plunging nearly 15% in the pre-market after the company posted a sales miss and swung to a loss. This is a company in transition, moving away from selling those copycat GLP-1 drugs and now partnering with the likes of Novo Nordisk to sell those drugs. But that is turning out to be much more expensive than investors had thought. And we end on AST Space Mobile. That stock also plunging 11% after it missed on revenue and posted a wider than expected loss. There was a lot of excitement around this name heading into earnings yesterday. Shares surged 10% around this idea that it could provide cell service directly from space here to here on Earth. But now investors are questioning how fast it can reach that vision. John.
Yahara, thank you. More from Yahara later this hour. On our radar this morning, President Donald Trump saying the ceasefire with Iran is on massive life support after rejecting Tehran's latest peace offer. Trump calling Iran's response a piece of garbage, but saying a diplomatic solution is still, quote, Very possible. Elsewhere, 16 of the nation's top executives are set to join the president on his trip to China. The CEOs of Apple, Tesla and Citi. Among those travelling to Beijing, one notable absence, the Nvidia CEO, Jensen Huang. And finally, South Korea's Kospi index shedding more than $300 billion after a policymaker suggested paying citizens a dividend from taxes on AI profits. The official clarifying the funds would instead come from excess revenue rather than a new tax, sparking somewhat of a rebound, but a little bit of a taster of maybe what's to come further down the line.
Clearly, there is increasing concern politically and among populations about what AI means for their jobs, what it means for their profits. If the best argument you can make for human capital is that it's cheaper than AI for now, you have to imagine that's not exactly comforting for where AI could go in the future, considering it's a machine. It doesn't have to eat and doesn't have to sleep and can be endlessly productive. It also highlights how far the Kospi has gone. Samsung, I believe, is the second most profitable company in the world behind NVIDIA, and this comes with this incredible demand for its chips. How much could they be subject to pay for some of the concerns over in the South Korean economy that are coming from very real pressures, whether it's oil prices or whether it's just some of the cyclical slowdown that you're seeing around the world?
We don't know how this turns out, so we've got to assume a couple of things for this to happen, but let's assume a couple of things. If the number of winners is smaller, if the number of people unemployed goes higher, and if the outlays for governments increases, then the tax revenue's got to come from somewhere. Where's it going to come from? It's going to come from the small number of winners. Clearly, corporate taxes has got to go up on some of these major winners. That's if you assume that the number of winners gets smaller and the number of unemployed gets higher. That's still a big assumption at this point.
And right now, it does seem like governments are treating this as an existential risk. They want to win. They want their companies to be the best and strongest in the AI race so that they can win market share globally at a time when this is really the next big thing. So if that's the case, how much does this prolong when we start seeing taxes like this? Because you've seen that push in the White House and then the pushback being like, well, we want to win. So you can't really crimp anything with these companies.
And maybe this is on the table for 28. I don't know. Maybe that's the biggest threat to this rally. Who knows? But it's certainly going to be part of the conversation around the politics for the next few years.
When you bring that up with different analysts, they're like, yeah, la, la, la. But look at the earnings because they're amazing.
Yes.
So, you know, we're your little head off, but, you know, it's not coming to fruition yet. And that's sort of where people are right now.
What do they say? What did Chris say? The less you know?
Yeah, I mean,
the less you know.
The less you know. I think that has to be the theme when you just can't understand what the policy could potentially be.
Let's try and understand what's happening in the UK. Check out the bond market this morning. Gilt slumping, yields higher across the curve. 30s at levels we haven't seen since the late 1990s, 98 to be precise, 10s at 5%. Even with that move, the currency weaker. The brew right now, as Bramo would say, in the UK is very toxic for the Prime Minister Keir Starmer, just about holding on as the calls for his resignation continue to build. Bloomberg's Lizzie Burden joins us now from Downing Street for more. Lizzie, the last time we spoke, the Prime Minister had rolled up his sleeves, he dropped the tie, he made an aggressive push to hang on to power. How big has the pushback been in the last 24 hours?
Yeah, and he's still sounding defiant, John. He's insisting that he won't go down without a fight. He told a meeting of his top team behind that black door this morning that he takes full responsibility for those abysmal election results last week. The Labour Party's election selection process for a new leader hasn't been triggered because he says the country expects him to govern, and that's what he's going to do. Now, we also report, interestingly, that Labour officials say his strategy is to dare the Health Secretary, Wes Streeting, to announce the leadership challenge that he's been cooking up for months, because he knows that many in the party don't want a Prime Minister, Wes Streeting. So he wants to incentivise him to block a Streeting contest, or a contest that involves Streeting. But then, out of that meeting, we had a parade of 5 ministers coming to tell us that they are backing the Prime Minister. I'm interested in the ones who didn't want to talk to the cameras, about 15 of them walking past, the likes of Ed Miliband, the Energy Secretary, with a face of thunder, it has to be said. He did not want to talk to anyone, but privately we know that he's been urging Starmer to set a timetable to go. The likes of Streeting, silent on their way out. And behind the scenes, we know that dozens of MPs, at least 80 of the 403 Labour MPs, have called for Starmer's departure. One junior minister has resigned. And so for now, I'd say we came here earlier thinking maybe there could be a lectern, a podium in Downing Street with Starmer resigning. It isn't imminent. It doesn't seem like it's imminent yet today. but it still remains a question of when, not if, Starmer's going to go.
Lizzie, what's the main issue that Keir Starmer is being accused with in terms of sort of failing his duty, and who is lined up to take over?
Failing to connect with the public to be able to win elections. No Labour MP wants to get to the general election in 2029, if that's when it comes, and be wiped out by Reform UK, Nigel Farage's party. They don't want to lose their seat to the Greens either, and the threats coming from left, right and centre, literally, to Labour. But interestingly, when you look at the markets, you were talking about the gilt moves, the market's behind Starmer, seemingly, because the market doesn't want anybody who would be more fiscally lax than Starmer. Now, what would be interesting is if Starmer goes, but you keep the Chancellor, Rachel Reeves. She's known for her fiscal prudence, and allies of the Chancellor have been telling the Financial Times that she could stay, even if there's change at the top.
Lizzie, we often talk about guardrails. I just wonder if this is a home bias of ours. Of course, the first thing you and I do is go to the gilt market. Lisa's all over it. The moves we've seen, the highest numbers we've seen since 1998. How much do those moves matter to the left wing of the Labour Party?
I've been asking myself that question all day. I'm so glad that you said it out loud. We know the importance of the bond market. Rachel Reeves knows the importance of the bond market. I believe Keir Starmer knows it as well. But to your point, does the left wing of the party know the importance of the bond market? Can it have such a short memory? You were talking about 2022 and the Liz Truss moment. Are we going back to that already? That is the question that journalists who we've been shoulder to shoulder here in Downing Street today waiting for election have been asking ourselves. How are we here already when Starmer was in with a landslide vote just a couple of years ago? And yet we've got this turmoil around the top of the leadership yet again. It smacks of what happens to the Conservatives not so long ago, but it is a short memory in politics when you've got the charisma of Nigel Farage on the right, Zach Polanski of the Greens on the left. It's difficult for a man like Keir Starmer to cut through when, again and again, it just seems like he cannot read the room. Just saying over the weekend he intends to be here for another 10 years. And as I say, that defiance on display today.
Lizzie, looking forward to your coverage over the next few weeks. I get a feeling this story is not going away. Lizzie Burden there outside number 10 Downing Street. This market pushing back, yields higher across the curve.
You know, it seems like financial markets and sentiment are in two different worlds. The idea that bond markets are saying, where's your fiscal plan? And people are saying, well, you're not very likable. You know, I want to go out for a beer with you. And until you can bridge that divide, you know, potentially there will be this tension in financial markets.
He's got bigger problems than not just being likable. That's for sure.
Seems to be the suggestion coming from markets as well.
We'll return to that story, no doubt, over the next few days. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahira has more. Hi, Yahira.
Hi, John. Fed Chair nominee Kevin Warsh is one step closer to confirmation. The Senate advancing Warsh through a procedural vote, setting up a vote to confirm him to the Federal Reserve Board later today. A separate vote is expected to pass later this week, officially confirming him as the new Fed chair. The U.S. Treasury Department blacklisting 12 firms and individuals, including some based in Hong Kong, over the sale of Iranian oil to China. They are accused of facilitating the sale on behalf of the Islamic Revolutionary Guard Corps. And the UAE reportedly carrying out previously unknown military strikes against Iran. The Wall Street Journal reporting the Emiratis launched attacks on an Iranian refinery in the Gulf last month. The Emirati government declining to comment on the report, but asserting its right to respond to threats. That's your Bloomberg Brief. John.
Yahira, thank you. Thanks for that update. Up next on the programme, mounting inflation expectations.
This month, we're definitely going to have a bit of a spicier inflation report. Ultimately, it matters how all of these inflation numbers that we get this week come together to form a PCE inflation forecast.
Up next, we'll catch up with Greg Daco of EY, live from New York City. You're watching Bloomberg TV. This is Bloomberg Surveillance. Bit of weakness out there. Semis down this morning, hence the move on the Nasdaq. We're down by 0.8%. On the S&P 500, negative by 0.4. The next stop for this market is CPI, later this morning at 8:30 Eastern Time. Just run through the estimates for you just briefly. Year over year, headline CPI, we're looking for a number close to 4% here. 3.7 is the median estimate in our survey. That's up from 3.3. Core, stripping out the volatile food and energy type stuff, 2.7. Much lower, but above the previous read of 2.6. That's all year over year.
On one hand, you could say energy costs you can look through because they tend to be temporary, fleeting, self-correcting in nature. This time, though, they come with other types of shocks as well. You're seeing the prices of food go up. You're seeing the prices of semiconductor components go up. You're seeing the prices of metals of all types go up. As a result, people are wondering, well, how many different price inflation shocks can you have before suddenly you have a problem? And that's why you're seeing it bleed into the bond market.
The price of energy going up as well this morning, higher by close to 4%. 101 on WTI. Brent crude approaching 108 and up by 3.4%. The president saying the Iranian proposal totally unacceptable. The ceasefire on life support, describing a hospital scene. Pretty dark stuff coming out of the Oval yesterday.
I felt really bad for the hospitalized ceasefire. I'm thinking to myself, has it called its relatives? What's it going to have for a meal? Look, it does highlight how the bar has gotten lower for some sort of military action. We're still not pricing that in, though. This move that we're seeing in crude, not even close to what it will be if there is actually a military escalation.
Things are fragile. They have been for a while. The blockade continues. All of this ahead of the president's trip to China. Under surveillance this morning, mounting inflation expectations.
This month, we're definitely going to have a bit of a spicier inflation report. Ultimately, it matters how all of these inflation numbers that we get this week come together to form a PCE inflation forecast. We do see inflation coming down, in some ways very much in line with how markets are pricing.
So here's the latest this morning. Investors are waiting fresh inflation data out in just under 2 hours' time. Greg Daco of EY writing, while we still expect inflation to ease later in 26 as labour market conditions soften, the near-term inflation outlook has shifted enough that we no longer expect a rate cut in December. Greg joins us now for more. Greg, good morning. We'll get to the expectations for the Fed in just a moment. Let's just start with what you're expecting to see at 8:30. What are you looking for?
Well, we're looking for a 0.5% increase month-on-month when it comes to CPI and 0.4% month-on-month when it comes to core CPI. So there is some pass-through of these higher energy prices onto core inflation. That will lift CPI inflation closer to 4% and lift core inflation closer to 3%. And I think over the next couple of months, we're going to see even further upward pressures, because what's happening is that we're really testing the price of growth. We're testing the price of trade and commerce. We're testing the price of labor with the immigration constraints. We're testing the price of energy, and we're testing the price of technology. All of these supply shocks are leading to rising inflationary pressures that are gradually eroding growth momentum. So it's not just a story about this month, but it's really a story about the next few months and where we end up in this trade-off between growth and inflation.
Pretty uncomfortable position for the incoming Fed chair to be in, for Kevin Warsh, Greg. I just wonder how you think he's going to handle those situations, that situation we're going into.
Well, I think we've heard from most on the FOMC policy committee that essentially they're leaning towards more focus on the inflation side of the mandate. And that is the right approach right now, because if you look at the two mandates, you have the unemployment rate that is still low. I think it is hiding some underlying fragilities. We saw that the underemployment rate, which includes part-time workers that are looking for full-time work, rose a little bit in the month of April. But in general, there is a sense that the labor market is still in this balanced environment, whereas inflation is moving away from the 2% target, and that is getting a lot of attention. And I think when Kevin Warsh steps in as the FOMC chair, he will have to convince his colleagues that there is any form of need for easing. The current direction of travel when it comes to policy is actually, in my opinion, going to be reinstating a two-sided statement when it comes to the possibility of rate hikes over the next few months should inflation prove more persistent than currently is the case.
Greg, a lot of people think that this isn't feasible, given the fact that President Trump is the one who nominated Kevin Warsh and mandated him with cutting interest rates. Why do you disagree?
Well, I think generally speaking, he will first have to convince his fellow FOMC members that his intents are essentially geared towards fulfilling the dual mandate that the Fed has and not any type of political bias. So I think he will be restrained in that regard when it comes to any type of political desire to lower interest rates, because the rest of the committee is not convinced at all that there is any need for policy easing. If anything, as I was just saying, there is probably a desire to maintain a slightly restrictive monetary policy stance. And we may see a few that become more vocal with the need to tighten monetary policy, because again, this is not just about this energy price shock. It's about the layered supply shocks that we've been seeing over the past year and a half or so, which are leading to higher inflationary pressures and eroding growth momentum.
Greg, how much, if you stripped out hyperscaler growth, would you start to see a truly stagflationary type of backdrop taking hold in the United States?
I mean, that's a great question, Lisa, and I think we've spoken about this in the past. When you look at all the supply shocks, from the trade supply shocks, the immigration supply shocks, the geopolitical supply shocks, and the AI-led tech revolution, we're very fortunate to have this AI-led tech revolution that's underway that is supporting supply-side dynamics, because absent that investment in AI that's been a key conductor of economic activity, we would be seeing much, much lower growth. So to answer your question, the AI boom that we're currently seeing, which is in the initial stages of greater infrastructure spending, greater investment in the semiconductor field, greater investment in corporate adoption, that is a great support to economic activity. But I always come back to this notion that what we're seeing with the US economy right now is a narrow foundation to growth. Affluent consumers, AI investment, and asset price appreciation are currently leading growth. But that makes the economy more susceptible to potential headwinds that may come again and again over the next few months.
Elisa, it's such a fantastic question. Just imagine if we had a $1 trillion infrastructure spending program coming out of the US government and they said, yeah, we'll do it again and we'll increase it a year later. Basically got essentially that close to it from a handful of companies on the West Coast.
When you start talking about the scope of the spending and you start seeing that it's poised to exceed the defense spending budget next year, it gives you a sense of what we're looking at. If you take that out, the rest of the economy is at trend growth or even potentially below. And that's a real problem. How do you cater to that side of the economy while not stymieing what we're seeing over on the other side?
Hey, Greg, it's good to see you. As always, thank you, sir. Greg Daco there of EY. To your point, it's an economy increasingly geared to the capex spend of a handful of companies. It's also the higher end of the K, the upper end of the K, increasingly geared to the good feelings you get from financial markets all-time highs. And both those stories are interconnected.
And they're fueling inflation. If you take a look at why core PCE is increasing at a faster pace than CPI, it's because of the inputs that are being juiced by some of these hyperscalers and the purchases that they're making. You start putting this together and you say if the Fed were to cut rates to help the lower end of the K, it would just juice the profits that much more, and frankly the returns in the financial markets, which would only widen the K. It's sort of just an incredibly difficult, fraught moment for a central bank that is faced with a dual mandate that on the margins is somewhat still in conflict.
30s at 5 this morning, just crossing that level, yields up by a basis point or two, 5%. If TK was around the table, he'd say overtaken by events. You want to draw down the balance sheet here, reduce it. Incoming Fed Chair Kevin Warsh, that's a big challenge with yields at these levels.
He's gotten a pass for the next couple of months. Let's see what he does after that.
Up next on the programme, Ed Yardeni of Yardeni Research, Liz Economy of the Hoover Institution, David Tinsley of the Bank of America Institute, and George Saravelos of Deutsche Bank. The second hour of Bloomberg Surveillance just around the corner.
This month, we're definitely going to have a bit of a spicier inflation report.
The inflation genie has been let out of the bottle.
We now think inflation could bubble up to 4%.
Well, the last thing we need is additional monetary stimulus.
The Fed's going to stay on hold for a while.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Pulling back from all-time highs, down a third of 1% on the S&P, down by 0.7 on the NASDAQ. A ceasefire on life support, driving crude higher. WTI and Brent. WTI, triple digits, 101. Brent, 108, and pushing yields higher across the curve. 2s, 10s, and 30s. 30s north of 5% briefly this morning, 4.99. Heading into this, 90 minutes away, inflation data just around the corner. CPI before PPI comes tomorrow.
Yeah, and right before retail sales. And what the trifecta of economic data shows us this week is that people are growing more concerned about inflation than they are downside risk to growth. It was the opposite, say, around 2 months ago when people were gaming out how long this could go on. They thought if it reached this point, we would see some sort of fear of some sort of economic downturn. It hasn't happened. Maybe it's supported by spending on hyperscalers. Maybe it's supported by how much stimulus really has boosted the coffers of savings by U.S. consumers. Nonetheless, earnings have been incredible. People keep pointing to that, which has allowed inflation to remain higher than a lot of people had expected.
5 respected strategists on Wall Street upgrading their price targets since this war started. 5. And all 5 of them have pointed to the same thing: better earnings. Where's the threat to this rally going to come from? Let's bring up fixed income. Bring up the board. 2s, 10s, 30s. Are we getting closer to what Max Kettner of HSBC would call the so-called danger zone, with 10s at 440 and 30s essentially at 5%?
We're bleeding up to that level, although the pace of the increase has been relatively slow based on what we saw earlier in the conflict. We aren't seeing a massive increase in implied volatility in bond markets, which is a reason why it still is boiling the frog. We haven't hit that sort of panic button yet. Nonetheless, people have an eye on it, saying if the Fed really starts to talk about rate hikes, that could be the party killer, and that could be essentially when the cops come and say go home.
From my perspective, interesting analogy.
Thank you.
From my perspective, better than the hospital one. The 2-year is the more eye-catching move this morning, getting closer to 4% again, because that is a direct challenge to an incoming Fed chair who most people are arguing wants to reduce interest rates, yet you've got a 2-year yield above the policy rate. We did that last month. We're doing it again this morning, getting closer and closer to 4%.
There are an increasing number of Fed officials who have come out and said that they would have been in favor of removing the easing bias from the Fed statement. And even though they were not voting members, I do think Jackson Hole is going to be fascinating this year when Kevin Warsh has to come out and give some guide of how inflation is a choice and what he's choosing inflation to be. Because ultimately, is this an inflation increase they're willing to tolerate and say is temporary, or are they going to have to address this, meet the market's expectations and say, we have to tamp this down. We can't allow this to become normalcy, because right now consumers are paying these prices. They actually are accepting them. That's why retail sales is going to be interesting. How much are consumers saying, man, that really stinks, but I'm still going to pay $20 for an egg sandwich?
CPI, 87 minutes away. Do you do that?
No,
I hope you don't. Right, good.
No, I
just,
really
just
don't.
to clear that up. Inflation data, 8:30 Eastern Time. Futures right now, negative 0.4%. Coming up this hour, Ed Yardeni of Yardeni Research with a street high outlook for equities. Elizabeth Economy of the Hoover Institution ahead of President Trump's trip to China. And David Tinsley of the Bank of America Institute on the state of the U.S. consumer. We begin this hour with stocks hovering near all-time highs. Ed Yardeni boosting his year-end price target on the S&P from 7,700 to 8,250, writing the following: we've never seen consensus earnings expectations rise so quickly as they have in recent months. The result has been an earnings-led melt-up in the stock market. Ed joins us now for more. Ed, welcome to the programme. Been looking forward to this conversation with you. 8,250 year-end on the S&P 500. Ed, let's just talk about the earnings. Outside of recoveries, GFC, the pandemic, strip that out. Outside of recoveries, when was the last time earnings season and projections for earnings were this good?
I don't really recall anything like this. It's been extraordinary. The first quarter earnings expectations really weren't all that bad coming into the first quarter earnings season. Actually, they were holding up pretty well, and instead they turned out to be much better. And on top of that, the analysts are raising their second, third, and fourth quarter numbers. So now it looks as though we're going to have something like an 18% year-over-year increase in the first quarter. And for the year as a whole, they're expecting 24%. And that's definitely unprecedented. That's the kind of double-digit gains you see coming out of a recession. You don't see it in an economy that's been growing for a while.
Ed, looking across industry groups, the semis right now make up about 18% of the S&P 500. How much heavy lifting are the chip players doing?
Well, I think that's part of the story, but we're also seeing that the earnings expectations for the small caps and the mid caps have been going up to record highs. Those two areas of the market were actually sort of in a coma, flatlining since 2022 in terms of earnings expectations. And then over the past 6 months or so, we've suddenly seen them picking up and going to new record highs. So I think earnings breadth is actually improving. And if that's the case, that should lead to an improvement in the breadth of the market.
How sustainable is this, Ed, given the fact that we're hearing about consumers increasingly pushing back on price increases, increasingly being choosy as a result of some of the inflation that they're seeing across the market?
Well, you mentioned it before. There's a widespread belief that this is the K economy, where a lot of people are facing an affordability crisis and only a few people are doing well. I think that's, I'm not dismissing that, but I think a lot of that misses the impact of demography. I'm a baby boomer. I'm still working for a living, but I'm seeing a lot of my friends retiring, and the baby boomers collectively have a record $89 trillion of net worth, and they're starting to spend it. So all this anxiety about disposable income going flat, well, that's natural. I mean, baby boomers are at the peak of their careers and they're retiring, so that's going flat. Meanwhile, they're spending their retirement assets, and so they're continuing to spend. And I think a lot of baby boomers are helping their young adult children, maybe with mortgage payments, helping out with the grandchildren's after-school activities, some of the fees there. I see this from personal experience as well as from my friends. And so I think that's what's missing here, and that explains why the consumer has been so remarkably resilient, and I think that continues. So I don't really buy the idea that this economy is just being propped up by the capital spending on technology by a few companies. I think the consumers are definitely there. And the weakness in the consumer in the fourth quarter and the first quarter was weather related. So we're about to test that. We'll see what retail sales looks like up ahead here and put it all together. And I think the economy remains resilient as it has been since the beginning of the, well, I call it the roaring 2020s, and so far so good.
If that's the case, Ed, then isn't it true that we would see a more sustainable inflation rate moving higher as a result of the increased consumer spending power, the increased amount of money, and frankly, supply shock after supply shock that's hit the economy?
Yeah, that's a good point, and I think it's we have a recent example of what can happen, and that was in 2022 when we saw a spike in energy prices, but that was on top of supply side disruptions and supply chain disruptions. And you can argue that the same thing is happening now, but the big difference is wage inflation is really moderating, and we have a labor market that's in equilibrium, supply equals demand. So we're not seeing a lot of upward pressure on wages, whereas we saw a tremendous amount of wage pressure in 21, 22, and there was a lot more demand than supply of labor, and that led to a wage price spiral. So I think what's missing on the inflation side this time is a wage price spiral. We certainly have an energy spike, and that'll certainly lead to higher inflation for the next few months. But I think both the bond and the stock market have basically looked through it. By the way, I kind of view bond yields of 4.25% to 4.75% as normal. I'm not getting freaked out by it. That suddenly we're going to see the bond vigilantes act up, though. I'm watching them right now. The bond vigilantes are acting up in Tokyo and in London. I don't see them here just yet.
So, Ed, with that in mind, just build on that. When does it become a threat, this move in fixed income?
Well, it's interesting. A couple of years ago, I think it was in 2024, we saw the bond yield going up from 4% to 5% in 3 months. That was August, September, October. And it got up to 5% on November 1st. And Janet Yellen, who was Treasury Secretary back then, said, okay, the Treasury is not going to increase the supply of bonds. We're going to do our increased financing in the T-bill market. And so the bond vigilantes are not the only players here. And by the way, the bond yield came tumbling down. And so the Treasury and the Fed could still intervene in the market to keep it from going above 5%. And on top of all that, I think we still have the carry trade going on, where I think a lot of hedge funds are, in fact, sitting there in the Cayman Islands, or at least their books are sitting in the Cayman Islands, borrowing in Japan at 0.75% and buying bonds and getting a nice spread on it.
Do you think Kevin Walsh has got appetite to use the balance sheet of the Federal Reserve to intervene in the Treasury market?
Well, I think Bessent, Treasury Secretary Bessent, has the appetite to do what he was against doing when Janet Yellen did it, and that is issue more bills and fewer bonds if that's necessary. I don't think they're going to just kind of sit there and let the bond yield go from 5 to 6%, and I don't think it's going to go there. I think there's a lot of the U.S. bond is still viewed as a safe haven, and there's plenty of reasons to worry about things these days.
Ed, it's good to see you, as always. Just a final note. The next time you write a boomer stimulus check, you know where we are, OK? Ed Yardeni of Yardeni Research.
Absolutely.
Are you getting boomer stimulus checks?
I am not getting
I'm not on the receiving end of those either.
I imagine I'll be doling them out at some point, and I've already started to think about, where to draw the lines. But a really interesting take, because even some of the potential endpoints for a roaring 2020s don't seem to worry him, like higher yields. Doesn't seem to be on his base case of issues to work about. The man who coined bond vigilantes doesn't see bond vigilantes being brought back into service in the United States anytime soon.
There's two ways of looking at this move, right? There's many, but here are two. You can look at this as a challenge to risk assets, or just a reflection of a more resilient economy, an economy that can handle yields at this level. I'm not talking about gilts, by the way. I'm talking about treasuries.
That's the reason why it hasn't been necessarily a cold stop to the rally that we've seen in equities, because right now it really is a representative of the growth that we're seeing underlying the economy. That said, there are pockets that really are struggling as a result of interest rates, the housing market being one of them, which clearly is a focus of this administration.
These sell-offs in treasuries often become self-limiting, because it starts to bite and then you get a turnaround. I don't think we're there yet with 10s at 443, 30s around 5%. Let's get you an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. The UAE's primary natural gas plant is set to return to full capacity next year. The plant has suffered damage from the Iran war after being targeted twice last month. The UAE estimating a financial hit of up to $600 million in the second quarter from the closure of the Strait of Hormuz. Amazon kicking off another round of financing in the debt market. The tech and retail giant is selling bonds across a record 6 maturities denominated in Swiss francs. It follows a $54 billion debt sale in March across U.S. and European debt markets. And the mayor of a California suburb resigned after agreeing to plead guilty to acting as an unregistered foreign agent for China. According to court documents, Eileen Wang admitted to posting pro-China propaganda at the direction of Chinese government officials. That's your Bloomberg brief. John.
Yahira, thank you. Thank you very much. Up next on the programme, a high-stakes meeting with President Xi.
I have a great relationship with President Xi. We're doing a lot of business, but it's smart business. I respect him a lot, and hopefully he respects me.
Up next, we'll catch up with Elizabeth Economy of the Hoover Institution, live from New York City this morning. Good morning. In 1 hour and 15 minutes' time, we'll get inflation data in America, and headline CPI year over year could come in close to 4%. The median estimate in our survey, 3.7. That sets the stage this morning for these moves. Equity futures declining near session lows on the S&P 500, negative 0.4. On the Nasdaq, we're down by 0.95. A weight to the tape this morning with this move in crude. WTI and Brent, WTI reclaiming triple digits, 101, Brent crude 107, and yields higher across the curve, 10s through 440 and 30s. Briefly this morning, through 5%.
We're talking about both the domestic market in the United States with inflation hotter than people would like, and also an economy that's growing. But we're also talking about global bond vigilantes, whether it's in Japan or whether it's the United Kingdom. This is a global market with yields pushing higher. At what point does that create a slowdown to growth that maybe isn't being priced in?
The big global event over the next 24, 48 hours is this one. Under surveillance this morning, a high-stakes meeting with President Xi.
I have a great relationship with President Xi. We're doing a lot of business, but it's smart business. I think you can see that with the fact that in Hormuz, they get a big percentage, 40% of their oil from Hormuz. There's been no ships coming in, no nasty ships coming in that we end up in skirmishes with. He'd like to see it get done. I respect him a lot, and hopefully he respects me.
So here's the latest this morning. President Trump traveling to China today for a summit with his Chinese counterpart Xi Jinping. The meeting on Thursday said to be shaped by the ongoing war in Iran. Bloomberg's Mike Shepard joins us now for more. Shep, welcome back. This meeting was delayed because of this war. How different are things a month or so later?
Well, because the war is continuing, John, it really does frame and shape the discussions that are going to start Wednesday night, our time, about 10 p.m. That is when the two leaders are set to sit down. That would be about 10 a.m. local time in Beijing. And the Iran war really will be first and foremost for the two sides to discuss. China will be pressing the president of the United States to bring an end to this 10-month conflict, which has really sown trouble across the global economy, mostly in the form of squeezes on the supply chain, especially for energy, a pinch that not only consumers here in the U.S. and elsewhere in the world are feeling, but especially in Asia, and China is no exception. The U.S., for its part, will be pressing China on the question of Iran, and that includes Beijing's support for the regime in Tehran. And that could include concerns that the U.S. Has aired that there may be some exchanges of military support, including arms sales to the government in Iran, as well as purchases of Iranian oil by Chinese company. And the U.S. just sanctioned a bunch of Chinese entities for those purchases, and we could see that discussed as well. But the two sides will also have so much other business to get through, but Iran certainly, John, will be first and foremost of them.
Shep, thank you, sir. Good to see you. Down in the nation's capital, Mike Shepherd there to build on this conversation. Elizabeth Economy of the Hoover Institution writing, the only channel of communication is economic. That is both where there is the greatest conflict, but also the most forward momentum. Elizabeth joins us now for more. Elizabeth, good to see you.
Thanks, great to be here.
What are you expecting to come out of this meeting later this week?
Look, I think there are basically three big buckets of issues that both sides want to address. The first, and I think most important, is that both sides really want to find some stabilization in the relationship. I think they're aligned around that. So developing a mechanism so that we're not doing a tit for tat on the tariffs and the export controls and investigations, I think is number one. And that's where I think you're going to get this board of trade and maybe further down the line, a board of investment. I think that's really the most important. Second, of course, and crucial for President Trump, are some big wins that he can take home, right? Some purchases of soybeans and who knows, energy, airplanes, of course. And we see some of the CEOs that are accompanying President Trump that are in these spaces. I think for China, they'd like the U.S. to just treat China as a normal country, right? Not to have the highest level of export controls, not to have the most investment restrictions, not to have the highest level of tariffs, but to really find a way to do sort of normal trade. And then third, I think, is that bucket of broader security issues, Iran, Russia, fentanyl. I think these are other issues. And certainly I should say the Chinese will raise Taiwan. I think these are the other issues that are going to be on the deck for the two leaders.
Point two, aren't they a normal country?
I don't think economically they're a normal country, no. And I think the sort of China's economic model is now presenting problems not only for the United States, but for the rest of the world. I think it's useful to note that 52 countries last year put in place trade defense measures against China. So the way that China does business really poses challenges for, not only advanced income, but now middle income and emerging economies.
There was a story, there have been a number of stories in a number of the biggest newspapers about how China has a lot more leverage than the United States and about how the economy is in a much better position to pose a real competitive threat to the United States. Do you agree with that framing?
Well, look, I think it's fair to say that China has an important chokehold on sort of goods that are essential to U.S. economic and national security, like rare earth elements and critical minerals, like active pharmaceutical ingredients. So certainly they've developed new leverage, new tools. But I think President Trump has the capacity to move past that in many respects, maybe to put on some virtual reality glasses and create his own world and negotiate from what he believes is a position of strength. The United States doesn't go into this without, any tools at its disposal. The tariffs have had some impact on China. It has export controls. It's been continuing to move forward on export controls around chip-making equipment just this past week. It had a letter of intent, basically an informed letter, which basically signals to some U.S. companies that they're going to have to put in some new export controls against Chinese companies. So I think there are tools that we have at our disposal, and the president will go in at least feeling stronger than many other people may recognize.
If that's the case, what's the signal that you take from Jensen Huang of NVIDIA not accompanying President Trump on this trip?
Well, look, I think Jensen's had a lot of attention, paid to NVIDIA, and the president, made a move basically on his behalf and on AMD's behalf last year when he allowed the sale of the H200s to go forward, which was something that he did against a lot of opposition, both within his own administration and Congress and within the national security community. Those sales haven't materialized. So I think maybe what would be the point at this point of him going? I think if you look at the companies that are accompanying the president in the tech space, many of them are a little bit of problem children. They have issues with the Chinese government right now. Either they're not getting licenses, they're under investigation, they're concerned about shrinking market share. So I think there will probably be an effort to get some of those very particular issues addressed in the summit.
Can we finish on Taiwan? And maybe a bit of a reality check to the narrative that we hear a lot in these kind of conversations. There is an opening here for them to make a move on Taiwan. The president's distracted. He's bogged down in the Middle East right now. What's your read on what's actually going to happen?
So I don't think the Chinese are going to make a military move on Taiwan, because President Xi really wants to have a peaceful resolution. I think he's planning to wait until 2028 when there's an election in Taiwan where he believes that perhaps the opposition party, the KMT, may come to power, and the KMT is more favorably disposed toward Beijing. So I think there's a window here where I think we're not going to see any military action. That being said, we also don't want to see President Trump give any more space to Beijing on Taiwan. I think, the administration certainly recognizes that Taiwan, basically produces over 90% of the most advanced chips that we need, both for commercial and military purposes, and it is essential to our national security. It's part of the first island chain. So I think what we don't want is for Taiwan to be central in this meeting or to see any give on the U.S. position.
We hear repeatedly that under this president, the administration, the U.S. is willing to give up its global leadership role. Do you see it the same way?
I think the U.S. is redefining its global leadership role under President Trump. It's not giving up. I think there's a misperception that President Trump has retreated from the global stage. The sort of idea that we're going to have a sphere of influence policy, only be focused on the Western Hemisphere. I mean, we are deeply embedded in the Indo-Pacific. We're clearly still in the Middle East. So I don't see any evidence that we're pulling back from our global positioning in the security realm. I also think what we see is, yes, the president has withdrawn the United States from over 6 international institutions and arrangements, but at the same time, he's creating new ones. His administration is creating new arrangements like the Shield of Americas and Forge around issues where the administration feels they're critical to U.S. sort of security and economic interests. So around, critical minerals, around rare earth elements, doing bilateral deals, establishing a new multilateral trade arrangement. So it's not a complete withdrawal, but it's a refocusing around what this particular administration considers to be sort of the essential U.S. economic and security interests.
Liz, it's good to see you in person too. Thanks for being here. Thank you very much.
Thank you.
Elizabeth Economy there of the Hoover Institution. We've heard that argument a few times. It's hard to make that argument given the activity we've seen from this president through the year so far.
Honestly, it's been a completely global focus, more so sometimes than even domestic concerns, especially as he heads over to China for the first time in about a decade.
Coming up on the program, we'll catch up with David Tinsley of the Bank of America Institute on the state of the U.S. consumer. Plus, Danny has your morning movers, hims and hers plunging with higher than expected costs for weight loss drugs. That name down by 15%. All-time highs coming into Tuesday, pulling back this Tuesday morning, negative by 0.4% on the S&P, on the Nasdaq 100 down by 0.9. You've seen the enthusiasm to buy this market whenever you get a pullback. Will this morning be any different? All the upgrades we've seen to price targets since this war started, all connected to the earnings story. Barclays 76.50, bullish on the profit outlook. HSBC 76.50, earnings strength. Yardeni on the program just earlier, 82.50, an earnings-led melt-up.
And when we spoke with him, he said he hasn't seen anything like this, especially not in a time where the economy has otherwise been growing. The only time he sees moves like this is coming directly out of a recession, and that hasn't been the case, at least for the past few years. How sustainable is this? Well, he talks about how the boomers are filling the coffers of all sorts of younger people, paying their mortgages, paying their bills, and they're retiring and having a lot of time and money to spend. Look, it's coming out in the numbers, and we'll get that confirmation on Thursday when we get retail sales. Are consumers still spending and powering this growth?
You're going to strip out about the boomer stimulus checks from the retail sales?
I think that's
Is that what you're going to do?
embedded. I think that's absolutely embedded. I mean, how many people who live in certain areas and have their phone bills paid by their parents are just clearly
certain areas of Manhattan.
Yeah, boomer stimmy kids.
You know,
yeah,
going the working day.
very much so. Yeah,
Just finished yoga.
Yeah.
You're wondering if they've got a job or not.
People who lunch, they do.
Boomer stimulus checks, right?
100%.
Funding San Ambrose.
I mean,
clearly.
Totally. Yes, that
Without a
is
doubt.
one particular one. Anyway, but you know,
It's a very New
helping the
York
economy.
conversation, forgive us. Okay, let's move on. Want to get to South Korea and this move in the Kospi. The Kospi overnight, dropping as much as 5%, then pairing losses. This is actually really, really interesting. If you're just joining us this morning, welcome. So you had a policy advisor, let's call it, to the president of South Korea, come out with a social media post talking about tapping the profits of AI-related companies to offer a dividend to the people. Then he walked it back, diluted the comments, got some clarity, etc., etc. But the drop-off in the equity market was instructive. And so was the policy proposal initially, in the way that people viewed it, because is that a flavour of things to come if we do go in a certain direction?
Citizens' dividends from companies that are among the most profitable in the world and that have seen a moonshot in terms of their price performance in the stock market. How much are a lot of governments going to turn to those companies and say, all right, now it's your turn to give back, because the rest of the economy is not growing very quickly and people are unsatisfied with how much prices are going up. Regardless of whether it's coming from semi-investments, regardless of whether it's coming from the war in Iran, there is displeasure on the part of consumers about how much prices are going up. Will these be prime victims, number one?
Yeah.
And is this something that isn't necessarily prime victims, but just sort of an inevitability that just isn't being priced into their valuations?
That's a political story further down the road. Let's get to the market story in the here and now. This move in crude. The proposal from the Iranians, totally unacceptable. The ceasefire on life support. Crude about 107 this morning on Brent. Triple digits on WTI. You take that 3% move in crude, you plug it into fixed income yields higher across the curve throughout much of this morning. 2's approaching 4%. 10s through 440, 30s through 5% this morning.
It's the inflation week that nobody wants. We've got CPI today, we've got PPI tomorrow, and then retail sales to give us a sense of all of that and how it's being bled into the economy. This is a price that will surge that much more if you start to see a re-engagement of military action. That's what I'm looking for. How much are people looking for? 120, 130? Should there be some sort of re-emergence of a hot war?
That's going to be a story for a little bit later in the programme.
I mean, that's what the bar is being lowered.
Potentially.
Yeah,
Without
I mean,
a doubt, I'm
that's-
with you. I'm right there with you. No pushback at all.
Cool.
2 hours away from the cash open with your morning movers. Danny Berger has more. Hey, Danny.
Hey, John, at the top of the hour, we got earnings from Under Armour, a really big miss for their EPS. Their guidance is between 8 and 12 cents. The expectation was for 23. So on the positive side of things, Under Armour says that the tariff refund checks that are going to be coming their way after the ruling against IEEPA is helping them. On the downside, they say, one, they've been making more investments, so that's been hurting them. 2, tariffs are already high for them. And they cite the war in Iran and the issue that is made for them in supply chains. They say they're taking a $35 million hit because of the war in Iran. So those shares getting pummeled this morning, down nearly 13%. Elsewhere, we got the official rejection from eBay to GameStop. The company there in a statement saying that the takeover offer from GameStop is neither credible nor attractive. It does set us up for a potential proxy fight. Still, there's a lot of questions as to whether GameStop can actually get this done, considering they're less than a fourth of the market cap of eBay. So GameStop shares, you see those falling 3.5%. Finally, we also got earnings from Hims and Hers. That's a big decline. 2 companies are really getting punished for missing, down 15.2%. It's because of higher costs tied to getting name brand weight loss drugs. Before they were doing copycat versions, they pivoted. They're using the drugs from Novo Nordisk, from Eli Lilly. A big restructuring cost tied to that, about $33.5 million. So shares sink off the back of it. John?
Hey, Danny, thank you. More from Danny Berger in the next hour. Slightly distracted here. New note from Max Kettner over at HSBC. I'll share some of the details with you. Still max overweight equities. We remain aggressively risk on in our tactical asset allocation. Some reasons for that. Sentiment and positioning not stretched yet, according to Max. The data, bottom-up strength in the US, almost unprecedented, he says. And this on fixed income. This is the important piece. We remain most underweight in treasuries. The why? Upside risk to US growth could be the next catalyst. for fixed income. This was a conversation you and I were having. What is the ultimate driver of what's happening here in fixed income? Do you see it as a reflection of a better outlook for growth or a threat to this equity market?
Part of the reason why you might be seeing such a recovery in earnings that has been tremendous and unprecedented is because of unprecedented growth. This is the bull case. How many people are looking to hedge against a downside risk, which would be a treasuries bet? Very few. Increasingly, people are worried about missing to the upside, and they're seeing that in earnings. They're seeing that in the price action, which makes sense. So you talk about the limiting factor of treasury yields. At a certain point, they're an encouragement to go into risk assets because they're not a good hedge about whatever's going to come next.
The latest for treasuries near the highs of the year. We're looking across the yield curve this morning. On our radar this morning, a fresh look at the state of inflation coming at 8:30 Eastern Time. Economists expecting CPI to rise 3.7% in April as the war in Iran continues to pressure global fuel and food prices. Elsewhere, the UAE has reportedly carried out military strikes on Iran. According to the Wall Street Journal, the attacks included a hit on a key refinery in the Persian Gulf, the move signaling a more aggressive front by the Emirates to protect their economic power. And finally, the Trump administration adding another release of emergency oil reserves in a bid to ease higher energy prices. President Trump also floating a suspension of the federal gas tax.
A lot of people thought oil would go to $250, $300. It's not. I mean, today it's at less than 100. When this ends, you're going to see it drop like a rock.
How long are you going to suspend that tax for?
Until it's appropriate. It's a small percentage, but it's still money.
Average gas prices recently topping $4.50 a gallon for the first time since 2022.
Look, you're seeing an increasing number of governments look to fuel some sort of consumer subsidy as they see energy prices go up. I will just add, that would cost $3.5 billion to the United States every single month that you do remove that 18 cents of a tax from each gallon of gasoline. Increasingly, this is going to become a fiscal problem. I feel like I am beating a drum that nobody wants to listen to. This is also helping yields stay higher because of the fiscal response that you're seeing around the world.
How much of a difference would it make? It will make a difference, but how much? We've had a move of about $1.50 to a gallon of gas in this country on average. We're talking about maybe removing a little more than 18 cents from that $1.50 increase. And I saw a lot of feedback on social media yesterday that if you want to really do something about taxes, remove the war tax over the last 2 months and the increase we've seen, the $1.50 over the last 2 months because of this war.
Yeah, essentially, if you go buy an $80 product and you get a $2 discount, it's not going to make you feel better about paying $78. And that's essentially the type of valuations that people are paying to fill up their gas tank.
I was tracking the work from the team just yesterday as they were working through who's done what. Georgia, Indiana, Utah have temporarily waived taxes at a state level. Lawmakers in Alabama, New York, Pennsylvania, South Carolina are looking at following here. We've seen gasoline stockpiles in this country on a seasonal basis near 10-year lows. What are we doing? Delaying the demand destruction. For how much longer can you delay the demand destruction?
And are you making it worse by not delaying the demand destruction because you're increasing or at least keeping demand constant at a time of a supply challenge, a supply crunch? This is the economic challenge that no politician wants to listen to.
Crude at triple digits on WTI so far this morning. Investors, of course, are waiting fresh inflation data due out in just under 1 hour's time. The Bank of America Institute Consumer Checkpoint Survey writing with or without gasoline. Spending was strong in April, posting the strongest growth in 3 years. But we see signs of pressure building on discretionary spending. Joining us now to discuss, David Tinsley of the Bank of America Institute. David, welcome to the programme. That's notable. Before we get to the details, I just want to deal with the headline. Are you still seeing really decent growth, even away from just gasoline spending?
Yeah, even away from gasoline spending, our card data in April was up 4% year over year, and in March it had been up 3.6%. So, and even if you look at the month-on-month increase, it was up about 0.5% stripping out gas. So yes, now one caveat, and it's really early to tell, is that the final week of April, the data looked weaker. So, if you want to be a glass half empty person, you might think that we're beginning to see some weakness creeping in. But that weekly data is so volatile, I wouldn't read too much into it just yet.
David, can you give us a sense before we get to the glass half empty? Because, of course, I want to go there in a bit. But I am curious how much you're seeing dispersion increasing between people who are in the upper income brackets and people who are in the lower income brackets. Is that continuing to be the story, or is that overblown at this point?
No, it's still a story. I mean, in terms of like the K-shape on spending, our higher income consumers in our data, their spending's up about 5%, give or take, year over year. Lower income's up about 2% year over year. That gap is large. It isn't totally widening further, but it's still very large. And when you look across to wages, in terms of the data we see, the payroll coming into accounts, amazingly, really, higher income consumers saw year-over-year pay growth of 6%, and the very top 5% saw over 10% year-over-year growth. Whereas right at the lower end, they're seeing wage growth of about 1.5%. So there's a big difference, and that obviously is driving some of this story about subsidies, etc. you were alluding to before we came on.
That's a tremendous statistic. The idea that the upper income, you're seeing up to 10% growth in the lower income, 1.6% wage growth currently in the backdrop. How much are you seeing both sides of the equation start to reduce their spending in the past week? I understand that it's volatile, but do you see it across the board?
Well, when you look at discretionary, which is really where we're, obviously focused on right now, the expectation that some people may be pulling back. I think where you see it is in items like clothing. There's a big discrepancy between clothing spend from lower income and higher income. I think in travel too, probably not so surprising. When people are thinking about booking their vacations, there's a distinction between higher income, which is pretty solid, same as always, really, with lower income. That looks quite soft. So I think, if you are this glass half empty person, you're looking at some discrepancies in those categories, and you're looking at the end of the month, and obviously that's feeding into your concern. But we have to, kind of go back to the fact that the overall data is solid. Jobs growth, not only in the BLS data, but in our own in-house estimate of payrolls growth, very solid. So to some extent, maybe the show can stay on the road over the next sort of, 3 to 6 months even if gasoline prices stay high. But there will continue, I think, to be these discrepancies.
So, David, just to build on that, and finally, some people might point to the tax refunds and say this is why you've still got a bit of a bounce, offsetting the pain at the pump and the issues with the energy story. But my question to you would be, what in your report can you point to that gives you confidence about the sustainability of this over the next several months? Your final point.
50% of the tax refunds paid have not been spent so far. They're actually banked. So that gives fuel in the tank, even for lower income consumers, for a number of months. And then at the higher end, you've got the wage growth situation. So I think, it's not all doom and gloom by any means.
We appreciate it, David. Thank you, sir. David Tinsley there of the Bank of America Institute. Someone around the table might be glass half empty. Maybe, possibly.
I think it's, a third empty, and I'm very concerned about it. Look, people are watching for signs that there's some sort of problem, but I think that what David Tinsley just said shows the issue itself, which is essentially wage growth increasing dramatically at the upper ends and not really growing enough to compensate for the increase in gasoline at the lower end. This is a political problem, even though it's not showing up in the averages.
That's the best point. It's a political problem. It's not a market problem yet. And that's the conversation we might be having in 46 minutes' time, that you're going to see the pressure building for consumers in America. But as we've heard from Strategas earlier in the last week or so, this is not a consumer-driven equity market rally. It's a tech-driven equity market rally.
And to the extent that it is consumer-driven, it's driven by the people who are profiting from some of the tech gains in stock investments and that are getting bigger wages. So this isn't necessarily hinged on those lower-income consumers continuing to spend.
It's a tech-driven sell-off this morning. We're down by 0.8 on the Nasdaq 100. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. SoftBank is in talks for a major data center project in France, sources telling us here at Bloomberg. The company is considering a multi-billion-dollar investment as part of SoftBank's build-out of AI infrastructure. The Trump administration is delaying a plan to suspend tariffs on beef, according to the Wall Street Journal. The president was poised to sign executive orders on Monday to address supply issues, but pressure from American farmers put the measure on ice. And a U.S. citizen infected with hantavirus aboard a cruise ship is being treated in a biocontainment unit in Nebraska, while another symptomatic person is receiving care in Atlanta. 15 others exposed to the virus are in quarantine at the University of Nebraska. In total, 18 Americans have been repatriated from that ship. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. More from Yahara in the next hour. Up next on the program, headwinds building for the US dollar.
There are two factors that drive currency values. One is related to macroeconomic fundamentals, and the second is fear. The dollar did strengthen when the Iran war started, fear, and now it's come back down, macro.
George Saravelos of Deutsche Bank joins us next, live from New York City. You're watching Bloomberg TV. So in 41 minutes' time, we get inflation data in America, CPI. Later in the week, we'll get retail sales. Just how is consumer spending? Caught up with Bank of America just moments ago. They put out the Consumer Checkpoint piece of research that I always enjoy going through. Card spending, spending growth, strong in April. According to the internal data from BofA, total credit and debit card spending per household rising 4.8% year over year. That's up from 4.3% in March. Excluding gasoline, some of you want the number, I'm sure. Card spending was still a strong 4% year over year. That's a pretty decent read on activity in this economy.
People are still spending, even when you strip out inflationary aspects. And when you take a look at who's spending, you can see that the upper income individuals are continuing to have plenty of cash, are seeing up to 10% wage increases, and are able to spend that money. That has been the story that is powering this market.
Encouraged, no doubt, by equity markets at all-time highs. As for those records this morning, pulling back just a little bit. We're down by a third of 1% on the S&P, on the Nasdaq down by 0.8. Under surveillance this morning, headwinds building for the US dollar.
We are in a world where there are two factors that drive currency values. One is related to macroeconomic fundamentals, and the second is fear. Countries around the world looking for a safe place to put their money. I mean, the dollar did strengthen when the Iran war started, fear, and now it's come back down, macro.
So here's the latest this morning. The dollar failing to hold on to war-driven gains as investors turn to riskier assets, including equities. George Saravelos, the global head of FX research at Deutsche Bank, joins us now for more. George, welcome to the program. Is it fair to say you've become incrementally more bearish on the US currency?
Oh, well, we've been bearish for the last 12 to 18 months in terms of our forecasts. But I think as the risks around the war look to be peaking, we have been increasing confidence on the dollar downtrend coming back. What's interesting now is it's a lot more concentrated in dollar China as opposed to euro dollar. So if you think about this time last year, all the big moves were happening in the euro, but now all the new lows in the dollar are being made in China, which I think is especially interesting given the geopolitical backdrop.
Well, George, why do you think that is the case? Why the switch? Why the turn?
So I think there's two elements. One is the Chinese authority side, which is now openly allowing the currency to strengthen a bit more, and you can see that via the behavior of the fixings and the onshore versus offshore basis. So there's a very clear signal coming out of China, also perhaps in anticipation of the Trump-Xi meeting that's coming in. But of course, these broader discussions around the role of the petrodollar, what's going on in Iran, the geopolitical shifts. I think these have opened up a broader question in terms of the geopolitical balance of power in the region. And at the margin, that is helping China.
The People's Bank of China put out a report yesterday that highlighted that global central banks' use of their swap lines reached a 2-year high in the first quarter, indicating that people were increasingly going to the Chinese renminbi as some sort of reserve currency. Do you take this as a signal, or is this the PBOC trying to fuel the narrative?
Well, I think what's very interesting is to look at the actual data, and we do have transactional data in terms of volumes and flows going on in the interbank payment market in China. And what you saw actually in March is some of these metrics made new highs. So there is increased usage of CNY going on in the background. It's very difficult to understand precisely what type of flow is driving that. But I would say in terms of the actual evidence we have from data, CNY usage has been rising since the start of the war in Iran.
George, how much is this getting skewed by payments that are being made to Iran for passageway, or Iran trying to get some liquidity through renminbi, given the fact that we're talking about the petro-yuan versus the dollar?
It's very hard to understand that type of flow at a micro level. As you alluded to, these are things that are going on in the background. But I think the takeaway I have is the fact now that the CNY is making new highs, even in broad trade weighted terms, is really telling me two things. One, the signal and the policy intention out of the Chinese is really to now allow a lot more CNY strength than we were seeing this time last year. And the second point is, despite really a very large negative terms of trade shock, which should be impacting China because it is a major energy and oil importer, you're not really seeing that being reflected in the currency, which is strengthening. And that's really sending you a signal about broader flow shifts taking place in the background, aside from the terms of trade shock and the higher energy prices.
George, it's interesting we're talking about potential US dollar weakness, but we're not talking about US policy. We're talking about international issues. When does US policy begin to set the tone for the next leg of this trade?
I think for sure US policy is relevant, and I'd break it down into monetary and fiscal, which is the broader macro variables we focus on. On this front, what's interesting is over the last 3 to 4 months, you've seen a pretty dramatic repricing of the ECB rate hiking cycle, the Bank of England, even currencies out of Asia. But in the US, in part perhaps because of the transition to a new Fed chair, you have not seen this move to pricing rate hikes. So I'd say the US policy has almost been relevant by its absence in terms of repricing a more hawkish Fed. I think it's the bar to start pricing Fed hikes, which would be one dynamic that would be a lot more positive for the dollar, is still high, especially with the incoming chair coming in over the next few months. So I don't really expect that to come back. And then the other aspect of US policy is, of course, foreign and geopolitical policy. And the big question mark is, how is the balance of power changed in the Middle East and globally over the next few months, both on the back of the Trump-Xi meeting and, of course, the Iranian war. And that does have the potential to influence exchange rates.
George, it's good to see you. Thanks for dropping by and bringing us an update on his views on the FX market. George Saravelos there of Deutsche Bank. In the next hour on Bloomberg Surveillance, we'll catch up with Emily Roland of John Hancock Investment Management, Angelo Zino of CFRA on this rip-roaring rally in tech stocks, plus Michael Gapen of Morgan Stanley on inflation data at 8:30 Eastern Time, and the Flexport CEO, Ryan Pedersen. The third hour of Bloomberg Surveillance up next.
We've seen perpetual market strength.
The eyes continue to be on earnings.
It's an earnings momentum-driven market.
It will continue to be an equity story as we go forward.
Things are about as good as they've been in a really long time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equities session lows down by 0.4%, pulling back from all-time highs, and an aggressive rip-roaring rally in tech turning into this, down by just 0.9% on the Nasdaq. On the Russell, down by 0.3. Turn to the commodity market. This is how things are shaping up this morning. Crude rallying. Brent up by 3%. WTI as well. Triple digits on crude. 101 on WTI. Brent crude just short of 108. And in the bond market, yields pushing higher. 2s out to 30s near the highs of the year. A 30-year at 5%. Heading into inflation data 29 minutes away. CPI up next.
And it may be closer to 4% than 3% at 3.7% year over year. Headline CPI expected in a median survey of economists. A real question about how the Fed deals with this and why we're seeing inflation. Is this the one-time impulse from higher energy prices and other commodity prices as a result of the Strait of Hormuz closure? Or is this a sign of the strength in the U.S. economy that can allow prices to sustainably remain higher? Those are the questions that could both support U.S. stocks while also causing a further sell-off in bonds.
Well, let's stay with consumption. We know what sentiment looks like right now. Rock bottom. Let's focus on spending. What are people actually doing? The card spending data coming out of Bank of America indicating, stripping out gasoline, a move of 4% year over year. That's decent spending growth in this economy.
It's been fueled by the wealth effect, with stock price increases also giving sense of complacency and a lot of assets to spend. It's also being driven by the K-shaped economy and the average, which is a U.S. economy that seems to be closer to boom time than it is to a recession. How many people have come on the show and said that they expect recession? How many people have said that they think that it's a greater likelihood of a downturn in economic growth than some sort of boom case that's going to cause the S&P to go to surpass 8,200? It really isn't that many, which is a reason why increasingly stocks can keep rallying despite the backdrop that we're hearing about inflation.
It's difficult to make the recession call when you've got deficits in this country of 5-6%. Right? It's difficult to make the recession call when you've got a handful of the richest companies on the planet with really strong balance sheets committed to spending hundreds and hundreds of billions of dollars. It's difficult to make that call.
It's even more difficult when you look at a population of wealthy individuals who have plenty of discretionary spending. What stood out to me was the idea at the upper income level, you're seeing 6% wage growth year over year as a result of a lot of the top tier jobs paying more on the heels of productivity. That wage growth is not being sustained at the lower end of the K, which is why the sentiment surveys can indicate a very different type of backdrop than the overall spending averages.
And certain parts of corporate America are capturing that story. Shake Shack can't pass on the higher costs, stock hammered. But as Chris Ferrone said on this program, basically, if you're looking to build an investment thesis off the back of Shake Shack earnings, you're probably not getting the call right in the equity market right now, because what's driving the equity market is not Shake Shack and the restaurant business, it's the tech sector.
It also is a subject of conversation last night at dinner. The cost of a burger at Shake Shack.
It took 2 hours. What happened?
Casa Bramo, there was a situation where the kids said that they were not going to eat at Shake Shack for lunch because it was just too much. It cost $20 for a burger and fries.
It's expensive.
And they weren't interested, so they were going to other cheaper options next door. You see the demand destruction in real time as a result of the value proposition not meeting their
Fast food is no longer cheap food.
Exactly.
That's been the shift in this country now for a number of years.
I'm telling you, it actually is a really good barometer of inflation when the kids come to you. And
Who's next door, by the way? Who's next door?
A really cheap Chinese place, which I'm
that's their preference. That's their preference.
I'm really concerned. Whatever,
Okay.
Let's move on.
Okay, we can move on. I'm happy to move on. I was just intrigued. Other people might be too. Equity futures on the S&P. Session lows were down by 0.4%. Coming up this hour, Emily Roland of John Hancock with stocks on a record-breaking run. Angelo Zino of CFRA on the risk of sentiment swinging negative. And Mike Gapen of Morgan Stanley reacting to the latest inflation print. We begin this hour with stocks inching lower as investors await the latest inflation data. Emily Roland of John Hancock writing, we continue to see equities struggling with valuations for long-term returns, but earnings growth is still a very viable return driver. Emily joins us now for more. Emily, welcome to the program. This is a conversation we had with Yardeni, who, by the way, is at 8250 year-end on the S&P. Outside of recoveries, post-GFC, post-pandemic, when was the last time earnings growth was this good?
Never. I listen to your show every day, and I'm trying to come up with like a new adjective to describe this quarter's earnings growth. It's like spectacular, stunning, shockingly good. Like, it's been awesome. 28% earnings growth versus an estimate of 13% coming into the quarter. And we have 10 out of 11 sectors showing earnings beats, and the magnitude is spectacular, coming from sectors in particular like industrials and communication services. So it's not just technology that's driving that earnings growth. Is 30% earnings growth quarter after quarter after quarter sustainable? Probably not. But we're doing our best to enjoy the sort of nirvana that markets are benefiting from a fundamental standpoint today.
Many people, as you know, Emily, aren't enjoying it. They complain about it. And that's been the story ever since we exited GFC all the way up and to the right. This bull market has been hated. They will point to concentration and concentration risk. Do you believe that's a problem still building?
Yeah, it absolutely is a problem. And we're back to having the top 10 stocks in the S&P 500 represent about 40% of the index. That's not a healthy environment. But I would point to international markets abroad as having even more of a concentration risk. If you think of what's driving these global markets right now, it's a semiconductor super cycle for the history books. And we're seeing emerging markets really lead the charge there. You look at spectacular earnings growth. It's coming from emerging markets. But the challenge is it's just a handful of stocks, John. It's just about 3 stocks that are driving that growth. So I look, for example, at emerging markets earnings season. It's been great, but the beats are actually really modest. We're looking at about a 34% beat rate in emerging market equities because of that concentration. Another notable thing is that semiconductors are actually in value indices. So there's been a lot of confusion for investors that are sort of focusing on styles right now. And because the PE ratios are so flattered by that forward-looking earnings growth, we're actually seeing semis really benefit value indices overseas, which I think is a notable dynamic for those of us that are doing attribution analysis on a daily basis.
Emily, coming into this year, you were a little bit cautious about the U.S. economy and potential growth in earnings among a lot of these companies. How much have you changed your outlook?
Well, one thing that's shifted for us, Lisa, is this fiscal sugar rush that we're going through right now. If we've been thinking a lot about sort of car analogies and this earnings engine being important. So think about what's sort of fueling the gas tank right now. Fiscal stimulus was really sort of pumping on the brakes last year. We had government layoffs. We had a lack of fiscal support. More broadly speaking, we had tariffs. Now this year, the fiscal impulse is on. You've got tariff refunds. You've got lower corporate tax rates in the wake of the one big beautiful bill. Consumer tax refunds are elevated. You've got elevated defense spending right now. So we've got this fiscal thrust right now that's really resulting in an improvement in the U.S. economy, while the Fed is actually looking at sort of tapping on the brakes here to prevent inflation from running away.
Emily, it's always good to hear from you. Emily Roland there of John Hancock. This Fed is hesitant to tap the brakes. This Fed is still somewhat committed to the next move being an interest rate reduction, which is why you've seen some pushback. And I would say more than some pushback, beyond just the three that officially dissented to the language in the statement initially at the last Fed meeting. We've seen a lot more than that in the last few weeks.
Part of that is because there have been sectors of the economy that have been left behind. You have seen sectors, entire sectors that have been left behind, housing in particular. And people point to that as a key component in this virtuous cycle of an economic recovery. You need those jobs. Home Depot, Lowe's, you hear that in some of their earnings. People aren't buying as many supplies or furniture, say, Restoration Hardware, another member who came out and had some colorful choice words a number of months ago. A question here, though, about how targeted they can be at a time where inflation is running as hot as it is.
If in the home builder industry right now, tough. Restaurant business, tough. Parts of discretionary, tough. If those kind of sectors, industry groups had bigger weightings on the S&P 500, the S&P would be down. But that's not the reality of this situation. You have to take what you've got. We've got 18% of the S&P coming from chips. And chips and the profit growth, these are the ultimate profit centers right now. These guys have minted money. And that's what's driving this earnings growth.
So as the Federal Reserve, how do you cater to the economy while not creating a bubble in stocks that are somewhat more economically independent based on the broader economy? It becomes a conundrum because you have the risk of inflating a bubble on one side of the equation, even as you try to cater to another that isn't feeling so great. And you're seeing that in sentiment. You're seeing that in the K-shape. You're seeing that in a whole other bunch of metrics that are not factored in to the S&P 500.
There's always a risk of making it too complicated. If you're a policymaker, you have to focus on the averages. And I mean central banker when I say policymaker. If you want to focus on disparity, that's a job of fiscal and that's a job of politicians. And I think central bankers get themselves into trouble when they start focusing on the nuances and the disparity.
Over to you, Kevin Warsh. Let's see how he ties that knot.
He's in a tough spot.
He's in a tough spot, and he's been given a little bit of leeway by Scott Bessent, Treasury Secretary, who said it's understandable why the Fed would remain on hold for a longer period of time. Nonetheless, down the pike, it could become more complicated, especially if inflation rates stay at these levels.
Futures right now negative by 0.4% on the S&P. Near session lows, the data some 20 minutes away. With an update on news worldwide with your Bloomberg Brief, Yahara has more. Hey, Yahara.
Hi, John. Several CEOs have been invited to join President Donald Trump on his trip to China, including Apple's Tim Cook, Tesla's Elon Musk, and Citi's Jane Fraser. One notable absence, NVIDIA CEO Jensen Huang, who was not invited, according to a White House official. eBay rejecting an unsolicited proposal from GameStop. The company saying the offer is neither credible nor attractive. Earlier this month, GameStop offered to buy the online marketplace for around $56 billion. And in sports, the Oklahoma City Thunder have swept back-to-back series in their push to become repeat NBA champions. The Thunder winning 8 straight over the Suns and Lakers. Meanwhile, in the East, the Cleveland Cavaliers have tied their series against the Detroit Pistons 2-2. The winner of that series will take on the New York Knicks. That's your Bloomberg Brief. John?
Yahara, thank you. We want that to drag out, right?
Yeah.
Everyone's exhausted. Injuries mount. Not that we want anyone injured.
No,
but a
but
bit of
it's
fatigue
true.
sets in.
Yes, well, I would agree. Although the Knicks have done so well that, I'm just very happy. I'm actually
You're
playing
bullish
that.
Knicks. You're on the same team for once.
For once we are. I mean, honestly,
Okay.
how could you not be when you went past the, cheering crowds, the excitement?
Very cool. Annmarie, back on the programme tomorrow. She'll join us from China on the president's visit to Beijing and that meetup, of course, with Xi Jinping. Up next on the programme, the Morning Kills Plus. We'll catch up with Angelo Zino of CFRA as the tech rally pulls back just a little bit this morning. Equity futures down across the board. The weight on the tape in tech and the chip sector. The Nasdaq this morning, fairly negative, down by almost 1%. From New York City this morning, good morning.
I don't really recall anything like this. It's been extraordinary. Now it looks as though we're going to have something like an 18% year-over-year increase in the first quarter. And for the year as a whole, they're expecting 24%. And that's definitely unprecedented. I think earnings breadth is actually improving. And if that's the case, that should lead to an improvement in the breadth of the market.
Ed Yardeni of Yardeni Research, street high price target on the S&P 500 now of 8250, 4-year end, the most bullish on the street. Asked a simple question. Outside of recoveries, which is when typically you see this aggressive improvement in profits, so take out GFC, take out post-pandemic, have you ever seen earnings growth like this? His words, I don't really recall anything like this. It's been extraordinary.
Leaning into the roaring 2020s with earnings growth that has exceeded by double what people were expecting. It was expected to be 13% growth. Instead, it was 26% growth. And it's coming from, yes, narrow stocks. You are seeing about half of that coming from the big tech names. At the same time, it is broader than that, and that's the reason why a lot of people are getting optimistic.
What can stop this rally? Is it the data? The data drops later. In about 14 minutes' time, at 8:30, we get CPI in America. Look at these numbers. The estimate for headline CPI, closer to 4 at 3.7%. For core, 2.7%, just getting further and further away from 2. Now, of course, this is not the preferred gauge of the Federal Reserve, but the PCE read ain't a whole lot better.
When I see this, actually, it's probably worse in terms of how quickly it's moving in the wrong direction. When you take a look at break-even rates, you see it's creeping higher to about 2.3%. Again, we're not talking another 8-9% inflation growth. Nonetheless, people are looking at this and saying, how can the Fed do anything other than be hawkish, given that inflation is moving in the wrong direction, and it's with myriad influences. It's not just energy costs.
Crude contributing to it, though. Look at energy this morning, up by more than 3%, 107, call it 108 on Brent at the moment. WTI triple digits at 101. You've heard all the headlines coming from the Middle East and from the president, including the Oval Office remarks just yesterday. The proposal from Iran, totally unacceptable. The ceasefire on life support. The blockade continues. That's the constant here. The blockade continues. The energy market is in a deficit. Crude prices remain elevated. And when you have moves like this, numbers like that, you'll see things like this in fixed income. 2s, 10s, 30s. Yields up by 3 basis points at the front end, now at 398. Get the wrong kind of data in just a moment. We're looking at 4% on 2s.
And if the economy is strong, why would it go down because of demand destruction? You add to it influence that the government has to try to get people to keep spending at the same levels, whether it's a gas tax removal holiday or whether it's other forms of subsidization, then all of a sudden you start to see how inflation can be sustained.
10s north of 440, 5% on 30s. That means equities near to session lows. Bit shaky on the tech trade this morning. We'll spend some time on that in a moment. We're down by 0.4% on the S&P. On the Nasdaq, we're lower by 0.9. That's the price action. Let's get you some morning calls. First up, Citi upgrading lows to a buy, citing optimism in the home improvement industry. That's rare. We're up by 2% in the pre-market. Your second call from Deutsche Bank, raising its price target on Intel, citing reports of customer traction in its foundry business. That stock has been flying. It's down this morning. Negative across the board, really, for some of the big chip players. Intel down by close to 5%. And finally, Wells Fargo raising its price target on Nvidia, noting a favourable growth outlook. That's another one, slightly softer this morning by 0.7. Nasdaq futures are pulling back after a record run for chip stocks. Angelo Zino of CFRA writing sentiment could easily swing negative. Near-term risks are supply chain bottlenecks that could get so severe that it hurts the rest of the AI ecosystem. Angelo joins us now for more. Angelo, welcome to the program. We've seen chip players absolutely fly, but the companies doing the spending, ex-Alphabet, Meta, Oracle, Microsoft, negative for the year. Down on the year, with chip stocks up by some 70% just in the last few months. Angelo, at what point do we test the patience of some of the investors of the companies doing all that spending?
Yeah, I mean, John, I think, we're kind of testing the patience right now to some extent. I mean, clearly we've seen this rotation in terms of where investors are flocking to, and they're flocking to where the wealth transfer has gone to, right? It's gone from really the hyperscalers, which had, just unbelievable free cash flow. And then they've kind of shifted that towards doing buybacks in recent years and hiking, dividends in certain cases. And they're now focusing more on, investing on the CapEx side of things. Clearly, the expectation, the hope is that as we kind of, look ahead over the next, 12, 18 months and even, further down the road, it'll be more than made up for through the higher earnings potential, as well as, eventually kind of trickle to on the free cash flow side. But right now, sitting here today, clearly all the excitement is where the chip makers are, and rightfully so. We've kind of seen all these bottlenecks really emerge here over the last couple of months. And again, rightfully so, because that's where the earnings power is going to be over the next 6 to 8 quarters. But as far as these cloud companies are concerned, I mean, the business models are still great. The backlogs are growing much faster than I think most had anticipated, especially Alphabet. I mean, that's why that has been the big winner. I mean, they've seen their backlog essentially over the last 9 months quadruple. So they've really been the key winner here, and it really is a testament to how important that stack is and controlling that stack.
Angelo, can you say the same thing about Microsoft, the same thing about Meta?
You can't. You definitely can't say the same thing about Meta. And I'd say as far as Microsoft is concerned, I mean, you haven't seen the type of backlog growth on Microsoft's side relative to Alphabet, or even, Amazon, a little bit less so relative to Amazon. Backlog growth over the last 9 months has been close to about 70% or so for Microsoft, but it's been highly concentrated at this point in time on OpenAI. You kind of look at where investors right now are really gravitating to. The excitement is on Anthropic's side. I mean, you've seen the ARR growth. Everybody knows this at this point in time, but you've gone to a run rate of about north of 30 billion going into Q2 versus about 9 billion exiting last year. So there's proven AI monetization from that company, and as a result, if you're more concentrated towards Anthropic's side, like an Amazon is like an Alphabet is, I mean, the belief is they signed a $200 billion order with them. You're going to be you're going to get that upswing, or just a better reward from that side of things. So Microsoft, is definitely in the penalty box at this point in time.
Angelo, we were talking to Jonathan Golub of Seaport Research yesterday, who noted that right now the hyperscalers are not booking the cost of some of their purchases of semiconductors on their statements, while semiconductors are booking the profits from those same purchases at the same time. Do you think that's a potential liability, say, in a year, when some of the hyperscalers start having to put the cost on their books at the time that maybe some of the growth rates are slowing down?
It depends, right? I mean, it all depends on whether or not the demand trickles through. I think you kind of look at where we are today. Again, I mean, the last 6 months, we've really seen some notable bookings growth. You look at just the big three, you look at Alphabet, you look at Amazon, and you look at Microsoft, and you've essentially seen a doubling in the combined backlog growth of those three companies over the last 6 months. The expectation clearly is, one, they're going to continue to see growth. Right, because we're not going to stop this AI hype train going on. at least from on the enterprise side. At least that's the hope. And that backlog is going to translate to revenue. The revenue number is much bigger than the cost number, right? So ultimately, if you're a believer of this kind of upswing that we're seeing in the kind of the AI momentum on the revenue side, even if we see growth rates start to slow, it's such a much bigger number than the cost side, that we should continue to see some decent earnings growth, profitability on that side of things. Now, do we see the free cash flow contribution? Probably not over the next kind of 18 to 24 months, because I really do believe that any type of upside that you see on the cash flow from operations will get directly reinvested into the CapEx spend again, which is what's helping the the semi trade at this moment.
How closely, Angelo, are you watching some of these bond auctions from the hyperscalers as they all turn and hope that debt investors will continue to have the appetite to finance their build-outs?
I mean, we're watching it. We're watching it closely. I mean, clearly, you want to see that appetite. You want to see the favorable rates. And again, we'll kind of see how this plays out here in the coming quarters and years. Not too concerned as far as the hyperscalers are concerned. I mean, they're going to get favorable terms, I think, almost regardless of the macro environment we're in. I think some of those maybe tier 2 players, some of those neo clouds that we're talking about, I think neo clouds are a really important play at this point in time, because you look at the CoreWeaves of the world, right? You look at the bookings growth that they've seen, they're almost kind of turning into some of these large hyperscalers. We just saw them nearly touch 100 billion in backlog this past quarter, but they are more reliant in terms of the debt markets at this point in time. So I think it'll be a little bit more interesting to kind of see what those tier 2 players, how the neo clouds look like here over the next couple of quarters, to see if we potentially see any cracks in the market. But at this point in time, things look pretty good.
Angelo, it's good to see you. As always, Angelo Zino there of CFRA. The chart of semis just vertical since the end of March. But I think we have to remember that we ignored a lot of good news for quite a while for this sector. How many times did we sit on the programme saying, why aren't the chips rallying? Why aren't the chip stocks rallying? Look at all this spending coming out of some of these big tech companies. It just took a while. Then we've exploded since the end of March.
Because the $800 billion of spending expected this year is probably going to go directly to those semiconductors. So why wouldn't that be a complete positive? Which is why these stocks have rocketed higher, even though some people have tried to poke holes. Everyone else says, we don't care. Take a look at the profits.
The Nasdaq futures down about 1%. There is a pullback today, driven by chip stocks. We'll see if that pullback gets bought later on in the session when we get the cash open in about an hour from now. Before we get there, CPI in America, reaction with Michael Gapen of Morgan Stanley. Inflation in America, that data crossing in just a moment, seconds away. The scores into it look like this. Equity futures pulling back by 0.4% on the S&P, on the Nasdaq down by close to 1%, setting the tone for this inflation print. This move in crude, WTI and Brent pushing higher today. Brent just short of 108, WTI at 101, and in the bond market, yields close to the highs of the year, 5% on 30s, north of 440 on 10s. With the inflation data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. No surprises here. The headline CPI month-over-month increase 0.6%, as forecast after a 0.9 move last month. The core CPI year on a month-over-month basis is up 0.4. That is stronger than was expected. So for the year, we have CPI up 3.8%. And the core up 2.8%. That's the highest CPI for year over year since 2022, I believe. And it is also more than anticipated. It's a jump of 0.5 percentage point. So let me check on what the latest breakdown of all the numbers is. And I'll get back to you.
Mike McKee, thank you. Just had a 3.99 print on the 2-year, just short of 4%. We come back down to about 3.98. It's an upside surprise on core. You'd expect yields to be marginally higher. They are up by 3 basis points on 2s, up by 2 on 10s, now through 5% a little bit earlier in the session. Comfortably just about through that number right now. Coming off the back of this in the equity market, Equities just a little bit lower. We're down by 0.4%. We hold on to those session lows. Likewise on the Nasdaq 100. But it's that upside surprise on core that gets your attention, Lisa, supporting where the bond market was coming into this print.
Yeah, you're seeing it rise at the fastest pace going back to 2022, albeit we've seen paces like this as recently as 2025 in September last year. A question here about whether you can write this all off as simply the inputs from energy. Well, core CPI suggesting maybe that's not the case, and it's the pace of increase that's moving in the wrong direction. Again, PPI tomorrow will be very interesting, and then retail sales will give you a sense of how much consumers are willing to absorb some of these price increases.
It's getting harder and harder to be a dove on the FOMC with numbers like that. You'd expect them to build in the next month or so, depending on the duration of this war and the energy shock. But inflation is much, much higher than it should have been without this war.
It's moving in the wrong direction. You cannot point to inflation expectations as remaining where they were. They're not necessarily flying away, but they're definitely increasing. And why shouldn't they? Because right now we're talking about the strongest earnings growth at companies that are able to pass along any kind of hit to their growth based on higher prices to their consumers. We'll see that again with PPI about what those increases in prices for the producers really are. And frankly, we're seeing it move in the wrong direction at an accelerating pace.
Notable that the positive surprise, not so positive, the wrong kind of upside surprise, was actually on core today, and we'll get you a breakdown of that in just a moment. Off the back of this, yields are higher by 2 basis points on 10s, 443.47 as things stand. For those of you interested, the intraday high of the year was back in late March. That was 448. So we're just short of that right now on 10s. On 30s at 5%, on 2s approaching 4. Mike McKee, are you still with us? Because you promised us a second look at this. Where's that upside surprise come from on core?
Well, right now, it looks like it's coming from a couple of different things. Apparel prices up 0.6%, and the owner's equivalent rent up 0.5%. Now, Michael Gapen could explain more of this to you, but basically that's a statistical quirk because we didn't get an October read on inflation because of the government shutdown. So we've got basically a catch-up right now. Motor vehicle insurance contained, that's been one that's been rising a lot, 0.1% this time. But airline fares up 2.8%, a little more than anticipated. So we've got a little broader inflation than was thought in terms of the headline rate that includes food and gasoline. Food prices up 0.5%. Food at home up 0.7%, and gasoline prices up 5.4%. Nobody's going to be surprised at that number.
Michael McKee, thank you, sir. If you're just joining us, welcome to the programme. I'll give you the breakdown month over month and then year over year. CPI coming in month over month at 0.6, the estimate 0.6. For core, on a month over month reading, that comes in at 0.4. The median estimate in our survey was 0.3. That takes the year over year, headline and core. Headline, year over year to 3.8%. That's above the 3.7 expected. Core CPI year over year coming in at 2.8%, above the 2.7 expected. Those numbers are hard reading for an incoming Fed chair who might otherwise have been looking for cut interest rates.
You could make an argument that 3% is okay, but not 4%. That is a problem child when it comes to inflation. When you look at the pace of increase in year-over-year core CPI, we're looking at the biggest increase since August of 2022. Again, we have to talk about not only the fact that inflation is increasing, but the pace of the increase and where it's coming from. It is not necessarily those gasoline prices.
That was not a good time. Michael Gapen of Morgan Stanley joins us around the table for more. Michael, good morning.
Good morning.
What catches your eye looking at this report?
Well, there's some hints of second-round effects of higher energy prices on core. So those airline numbers, the food at home numbers, there's also kind of spillage into headline through food because a lot of food prices are related to transportation costs. Right, so the concern here, the assumption here, I think from the Fed's point of view and ours, is that oil prices tend to give you headline effects but not core effects. And there's at least at the moment, given the magnitude of the rise in energy prices, some hints of those second round effects in core. We need to see if those persist. So to me, that's what catches my eyes. The 4/10 on core was not a surprise to us. That's where we were. And as Michael mentioned, there is some catch-up effect here on rents and owner's equivalent rent from the government shutdown last fall. So this number is artificially higher because of that. But you still have kind of what I'll call a trifecta here. You have energy prices pushing the headline. We think we have the last vestiges of tariff pass-through on core inflation, core goods. You saw the apparel number today. And then we had that catch-up effect on shelter inside of services. So 3 forces pushing inflation in this particular CPI reading higher this month.
If you were looking at the calendar right now, and I say to you the following, can you just circle where you see the peak for inflation this year? Where in the calendar would that fall?
On a year-on-year rate, May or June.
May or June.
We think we're at peak pressures now.
If that's the case, then do you think that the Fed should look through this?
With time, yes, but there are a number of forces here. This is our 4th major supply shock in recent years, and we've got evidence here of what I'll call a mix. How do you decide if tariff price pass-through is ending when you have some of these other second-round effects from energy prices? So we think ultimately, yes, they will be able to look through it, but I'll say look through it with a long lag. We think the Fed's on the sideline for the rest of this year.
What does it say that companies are pretty easily able to pass along the price increases that they're experiencing to consumers? We've seen that in profit margins, we've seen that in earnings, and frankly, we're seeing that in how quickly some of these price increases are transmitted through things like airline tickets.
Yes, it's not a surprise that energy prices get passed through quickly. That has been the historical record in the U.S. So seeing airline fares up as much as they were, we actually thought they'd be higher this month. I'd say that is pretty standard from a historical perspective. The tariff pass-through has taken longer. It's taken almost a year. That said, when we look at some of the granular data, non-labor costs reflect those higher tariffs, but firms were able to pass along a greater increase in prices and build in more margin. I think that speaks to pricing power, still strong underlying demand, but kind of an oligopolistic corporate framework, right? We've got some very large kind of quasi-monopoly type firms and industries. Typically, they have better pricing power.
If you are just joining us, welcome to the programme. Slight upside surprise on inflation data that dropped about 8 minutes ago. Equity futures recovering just a touch. We're off the lows. We're still down by 1/3 of 1%. Bond yields off the highs. Mike McKee standing by with a little bit more detail. Mike, when you have a second and third look at the details, does it bring just a little bit more comfort or not?
It doesn't really bring a lot of comfort. We do see some decline in things that had been tariffed, some of the things that had gone up in price because of tariffs. And we don't know whether it's because the tariffs were thrown out or whether we've just been past the peak here. But appliances are down by 0.4%. Household furnishings down by 0.5%. However, tomatoes, which is one of the things that was tariffed by the president coming from Mexico for the winter, up 15%. Coffee prices were up 2%. So we are seeing some impact still from tariffs in the overall numbers. But right now, the important thing probably, and I'll throw this over to Michael as well, is we got a 0.5% rise in services. And that's the area where people have been looking for a little bit of a break, given all the pressure on goods prices. And so services coming in a little stronger than anticipated.
Michael Gapen of Morgan Stanley still with us. Mike, is there some stickiness to all of this?
There is, but I take some positive sign from what Mike just said. I think in order of operations here, the tariff pass-through to goods prices should come first. And so having some hints of that, I think, is positive. So if you want to look forward with some, like a positive checklist, you need to see that happen. Core goods prices need to settle down in the next couple of months. Then the headline pass-through from gasoline prices and energy should start to fade after that. The longer story here will be, as Mike noted, what happens with services. That's where the stickiness has been. Maybe that starts behaving and then 2027 looks better. There's a lot of ifs, mights, or buts in that statement. But they all have to hold up in order to get a more favorable inflation outlook.
Given that we're seeing these kinds of numbers, is there any universe where it makes sense for the Federal Reserve to still have an easing bias?
Probably not. I think they told you in April they very easily could have changed that language. It wasn't discrepancy about doing it. It was more about timing. So I do think all of the inflation data and the solid activity data point to an adjustment in the language in June.
I got some pushback to that a little bit earlier. I'm sure Drew Mattis won't mind me sharing that he was the one who was pushing back against that. There's just one line, in fact, just a couple of words, doing a lot of heavy lifting in that statement.
There is,
right?
But that's...
Do we move beyond that world with Kevin Walsh?
Ultimately, I think he would like to, yes. I mean, he's obviously said the Fed's footprint is too large, and that footprint includes communication in a Fed that he thinks is hyper-talkative. So yes, if you're thinking, oh, there's interest rate policy and there's balance sheet policy, but then there's also the forward guidance. That's a tool. So yes, this is a tool that you can use. So there's only a couple of words in the statement, but it has large implications.
Some serious power.
Well, does it though? And this is actually my pushback to that. The market's right now pricing in a rate hike. So it might be doing some heavy lifting, but not really, because the market's saying, we don't believe you. We don't think that you'll be able to hold on based on inflation numbers like this. So at what point does the Fed have to confirm what the market is saying in order to keep prices actually somewhat subdued versus whether they otherwise would be?
I'd suggest the dissent to the language in the statement was such widespread, and it was following the meeting as well, that it did a lot of the work for Chairman Powell without him even really needed to change a word in that statement.
It opened the door to the potential for a change in the bias. I mean, we're talking around the margins here, not necessarily the actual rate hike, but this market's actually putting in, pricing in some chance of a rate hike. And does it have to in order to keep inflation at least not flying away at 2022 levels?
Mike, you talked about all the ifs and buts that need to take place over the next 12 months to get your cut in 27. I find it so hard to talk about 2027.
I know, it's way out there.
It's crazy, but let's just play that game just for a couple of minutes. What would it take to get a hike from this Fed?
So you need this number here on core. As you were mentioning, headline is approaching 4, but there's an energy story there. Core is at least a more reasonably acceptable 2.8. That needs to firm. The expectation would be that that is moving above 3 and maybe even towards 3.5 on a spot and forecast basis. If you get that, for whatever reason, a long, persistent oil price premium, inflation expectations moving higher, animal spirits on the demand side, then the narrative changes. If there's this wide gap between headline and core is kind of hanging around 3 or less and maybe nudging lower, it's a totally different story.
Mike, good to see you. Michael Gapen there of Morgan Stanley. Small upside surprise on CPI. Initially, yields spiked high. They've come back. Initially, equities held onto those lows. Equities have bounced back, down just 1/3 of 1% on the S&P. With an update on stories worldwide with your Bloomberg Brief, Yahara has more. Hey, Yahara.
Hi, John. Recapping the data we brought you just moments ago. April CPI data coming in slightly higher than expectations. Headline prices jumping 3.8% year over year. Core also higher. Prices continue to rise as the war in Iran weighs on fuel and food costs. Speaking of, President Trump saying he wants to suspend the federal gas tax of 18 cents per gallon until prices start to fall. According to independent budget analysts, that would cost the federal government about $3.5 billion a month in lost tax revenue. And speaking of, U.S. Defense Secretary Pete Hegseth and Joint Chiefs of Staff Dan Kane are testifying before the House spending panel. They are looking to justify the Pentagon's record $1.5 trillion budget request while facing questions from lawmakers. Hegseth and Kane will also speak to a Senate panel later this morning. That's your Bloomberg Brief. John.
Yahara, thank you for the update. Up next on the programme, we'll catch up with the Flexport CEO, Ryan Pedersen, with shippers facing the biggest disruption in years. Plus, Danny has your morning movers. Activist investor Nelson Pounce reportedly exploring a bid to take Wendy's private. That stock is up at a pre-market by close to 16%. From New York City, this is Bloomberg.
The assumption here, I think, from the Fed's point of view and ours, is that oil prices tend to give you headline effects, but not core effects. And there's, at least at the moment, given the magnitude of the rise in energy prices, some hints of those second-round effects in core. We need to see if those persist.
We'll see, and we'll see when inflation peaks. Michael Gapen there of Morgan Stanley, looking for that peak in May to June, the next couple of months. The next part of this conversation with this man right here, the JP Morgan boss, the Chase chairman and CEO, Jamie Dimon, taking place at 9:45 Eastern time, so about an hour from now. His response to what we're seeing in this economy, some of the issues, beyond just that, the opportunities in AI and this massive build-out and the rally we've seen on Wall Street, all-time highs. Coming into Tuesday once again, we've set a series of records this morning. Futures pulling back just a little bit as we get these numbers on the inflation front. CPI coming in just a bit hotter than expected this morning. On core, of all places.
Yeah, this is the reason why people are concerned. You're seeing an acceleration in inflation, core CPI year over year increasing at the fastest pace going back some 4 years. That's giving pause to people who are looking at potentially some sort of response from a Federal Reserve that might have to shift away from an easing bias. I mean, try to figure that one out.
There are some statistical quirks. We can focus on the details throughout this morning on Bloomberg TV, but those headline numbers are not good reading for an incoming Fed Chair, Kevin Warsh, who might otherwise have been looking to reduce interest rates. Equity futures looking to bounce off the lows. We're down by close to 1/3 of 1% on the S&P. We're down by 3/4 on the Nasdaq. With an update on the single names this morning, 41 minutes away from the cash open, Danny Berger has more for you. Hey, Danny.
Hey, John, a big surge coming from Wendy's this morning, up nearly 16%, up 15.5. The FT reporting that Nelson Peltz is trying, looking at a potential takeover, looking for outside investors. Those include Middle Eastern investors, apparently. They already own about 16%. The fund already has someone on the board of Wendy's, so an acceleration of that. Elsewhere this morning, in terms of the movers on reporting earnings, a huge volatile pre-market session for them. At one point, they were up something like 8%. That's because they had a clean beat. They also forecast expanding margins to come. But investors and analysts, as they're picking through the earnings, noted that specifically North America was weak for them, and that's concerning. Shares falling about 4 1/3%. Finally ending things with another earnings, Hims and Hers, a big restructuring cost coming from them, shifting from generic GLP-1s into branded name ones. It's been a big deal for them, but there are a lot of costs that come with that, so shares down nearly 15%, John.
Hey, Danny, thank you. Looking forward to the program. Danny Berger alongside Matt Miller in about 10 minutes' time. Global supply chains facing prolonged disruption following President Trump rejecting Iran's latest offer. The Flexport CEO, Ryan Peterson, writing, the Strait of Hormuz remains at a critical risk level. The industry is still largely in wait-and-see mode. Ryan joins us now for more. Ryan, welcome to the program. Out of 10, and 10 would be globalization nirvana and 1 would be pandemic mess. Just how bad are things right now?
Yeah, hey, great to see you guys. Well, it depends what industry you're talking about. I mean, for the oil industry, this is about as worse than it's gotten ever, I think. I mean, we're talking about 20% of the world's oil has been cut off since March 1st. So I think on that scale, you're close to a 10, 8, maybe it's a 9 or an 8. For container shipping and air freight, it's not that big of a deal. The Strait of Hormuz is a cul-de-sac. Container ships don't need to go in there other than for local traffic. Jebel Ali, the port in Dubai, is the 9th largest port in the world, but that's largely because it's a big transshipment hub. It's a choice. You can transship those containers in a different port. And the Red Sea, which has been cut off since December of 2023 for container shipping, that's already been priced in. That's been going on. Ships have been routing around Africa. So I think this is really an oil story rather than a logistics story.
How much have prices increased to ship anything, even if it's not through that particular region?
Yeah, the price, it can be a little misleading, like kind of the base price of shipping a container is only up 10 or 15%, but there's all these other surcharges. You have war surcharges as well as fuel surcharges. So you're looking like from Asia to Europe is up 50 to 60%, even for ocean freight. Air freight is close to double because it's so fuel driven. Yeah, so pretty big price increases. And you see price increases even on the Trans-Pacific, which, ostensibly is not impacted, but it's a global market, global capacity, et cetera. So prices are up there as well.
And there are questions around who wants to insure this industry going forward if there are these potential hotspots around the world. Do you see a time when prices will go back to where they were before some of the hotspots really emerged?
I mean, it all depends on what happens on the battlefield here. What happens is anybody's guess. And right now we're in a ceasefire, but it is, I think, by no means over. You saw Trump reject Iran's demands yesterday. Netanyahu said this is not over. So I would expect until it's resolved, then no, I don't think you're going to see normalcy. I mean, taking 20% of the world's oil supply off the market is just a much bigger deal than I feel seeing all-time high in the equities markets. For me, this is why I don't invest in equities. It's like hard for me to understand.
So, Brian, some people have come on and said it's not that it doesn't matter, it just doesn't matter yet because we had this massive cushion and we're drawing down inventories so much. When do you think it might start to bite?
Yeah, I mean, again, it just really depends on how this plays out in the military landscape, which is way outside, way over my pay grade to comment on. But as long as the strait's closed, I just don't see how you can price normalcy. And I was driving by, I live in California. I saw $9 gasoline.
Crazy.
At the gas station yesterday. So
that is bonkers. Ryan, thank you, sir. Ryan Peterson there, the Flexport CEO. I should have flipped the scale, shouldn't I?
Yeah.
But I think we got the picture.
I think 10 is bad.
Things are bad.
Yeah, 10 usually is good, right? But in this case, anyway, we're not really.
It is not globalization nirvana.
Yeah, all I could say is $9 a barrel. But just think if there was 18 cents less, that would make all the difference.
That is not going to move the dial in California.
What are you talking about, $9 gas?
Although California arguably might have bigger problems when it comes to things like energy.
Well, potentially, yes. And given how exposed also they are to the Asian markets and then some of the extra taxes that are placed on a local level. What he was saying, though, is really important, which is costs are going significantly higher, not just in transit through the Gulf, but just globally because of higher energy costs. You have to wonder also why a ship operator wouldn't kick up the cost. Who wants to be someone operating the ship right now, given some of the stories that you're hearing from the stranded Marines over in the
Those guys are pretty brave, but no, don't count me in. And I'm not brave, so I'm not sure if that helps you.
I was counting on you to go, move our, fertilizer through the Strait of Hormuz.
Could you do one of those shipping trips?
No, absolutely not. Through the Strait of Hormuz?
Multiple weeks? No, never mind the Strait of Hormuz.
Just in general?
I just mean, around the Cape of Good Hope. And
I get seasick. It would be really bad.
That would be your excuse? No special program. And you know who would? Annmarie, without a doubt.
You think so?
Oh, yeah.
She'd be like
offer AMH the trip of getting... Honestly, Annmarie would be on that ship through the Strait of Hormuz.
I would have
no questions asked.
I would have been on the cruise going to explore different areas in Patagonia. I totally would have been on that. And then getting hantavirus, I'd be that person.
Different. I just wouldn't go on a cruise.
Yeah, well, I understand that, but you'd go certain places. Anyway,
my position on that is well known. Okay. Tomorrow, Annmarie is going to be on the programme, back with us. She'll be in Asia, in China specifically, to bring you the details of that meeting between President Trump and President Xi. Equity futures looking to recover this morning. We'll get you the breakdown of everything taking place today in chips and inflation, and a preview of tomorrow when we catch up with Seema Shah, Principal Asset Management, Eric Johnson of Cantor Fitzgerald, Edward Fishman of the Council on Foreign Relations, and Victoria Fernandez of Crossmark. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.